Good morning. Thank you for joining us for the December 1st Chicago Teachers Pension Fund Investment Committee First Friday meeting. For the record, I am Jacqueline Price Ward, Vice President of CTPF Board of Trustees and Investment Committee Chair. This meeting is being held in person at our office at 425 South Financial Place. Please note the following. Oh, I'm sorry, I missed something. The investment committee is committed to the committee of the whole and it includes all CTPF trustees. A quorum for this committee is 7 trustees. Yes. The committee is meeting today for our first Friday educational presentation. Please note the following. Access instructions for remote attendance and instructions for in-person attendance have been posted on the fund's website. All participants, please wait to be recognized by the chair before speaking, and please limit discussion from each trustee to 3 minutes. Please note that our staff and trustees to focus on the business of the meeting will not be responding to messages from participants using the Zoom chat feature. Please forward questions to memberservices@ctpf.org. Again, memberservices@ctpf.org. We will now move to public participation. Do we have anyone for public participation?
And we have 2 other speakers who will be speaking in Spanish, if I could offer translation services to them. Good morning, my name is Michael Angulo. I'm a senior researcher with Worker Power Institute, which works closely with Unite Here Local 11 in Los Angeles, California, and Phoenix, Arizona. 2 months ago, my colleagues of Unite Here Local 11 who work at the Hotel Figueroa in Los Angeles came before you to discuss the ongoing labor dispute at the hotel. We have returned to provide update as this dispute has continued to escalate. CTPF is not invested in Green Oak Real Estate 2, which owns the Hotel Figueroa, but is invested in Green Oak Real Estate 3, which has a 0.17% IRR, underperforming the benchmark of peer funds by 10.15%, according to data provided by PitchBook as of Q3 2023, excuse me. Following expiration of their union contracts on June 30th, 2023, workers from the Hotel Figueroa and 52 other Southern California hotels have been striking to demand a fair contract that will allow them to provide for their families. As of today, 34 hotels have settled agreements that will provide living wages, affordable health care, and a pension so workers can retire with dignity and security. Bentall Green Oak and the Hotel Figueroa have failed to do so and are now outliers in the Southern California hotel industry. The Hotel Figueroa has also retaliated against workers engaged in protected concerted activity. As the Los Angeles Times reported, 6 days after notifying the company that they wanted to join the union, food and beverage workers who were employed by a third-party BGO contractor, Noble 33, were notified that the hotel's restaurant and bars would be closing and that they would be laid off. More than 100 workers, many with long tenures at the hotel restaurants, subsequently lost their jobs. Many are now unemployed and struggling to provide for their families. The union has filed charges with the National Labor Relations Board alleging the closures and firings violated workers' rights under federal labor law. Making matters worse, just days after the last firings occurred this February, Cafe Fig and outlets reopened with a new operator, but without the veteran workers who had kept the restaurants and bar running. This week, a class action lawsuit was filed alleging that BGO and its operators violated workers' rights under the Los Angeles Hotel Worker Retention Law, which requires in the cases of changes in management or ownership or hotels that the site's employees be offered continued employment for a transitional period. Last month, workers joined with clergy members from across Los Angeles to call for a boycott of the Hotel Figueroa. They delivered a letter signed by nearly 500 community allies demanding the hotel bring back the Figueroa 100. Workers, clergy, and community leaders are calling on tourists and visitors to choose alternatives for their travel and events until all the workers have won the dignity and respect they deserve, and the fired restaurant workers are returned to work. Later today, U.S. Senator Bernie Sanders will hold a rally at the Hotel Figueroa to call for an end to the labor dispute at the hotel and justice for the 100 fired workers. We ask that you join Senator Sanders and write a public letter to BGO urging the firm to resolve the ongoing labor dispute at the hotel and to ensure the restaurant operator rehires the fired workers and compensates them for lost wages. If BGO does not fix this situation, it has shown itself incapable of responsible management of investor funds and should not receive future investments. Thank you.
Why don't we let them present?
Yes, ma'am, I'm going to interpret.
Yeah. Okay, so no other presentations, just you're interpreting for these, their presenters.
Yes, that's correct.
They have signed it.
Okay, so I would like to hear the meeting. We have representatives had attended a couple months ago.
Yes.
Okay, and at that meeting, it was discussed that this is more of a union issue
Hmm.
than a pension fund issue.
Right.
Okay, and
Right.
so, you know, I want to go from there to the point of whether or not they have contacted the union.
We've contacted them to tell them that, but I'm not sure if they've contacted the unions or not.
Exactly.
And
Yeah.
at this point, being simply a pension fund, we cannot do what a union does. So, second.
Yes,
Yeah.
I was gonna let them present because, and direct them to, because I have been, having conversations with via text or, trying to figure out what is, this is clearly a union issue. Well, let me just ask you,
Yes.
what is it that you are asking of us so that we can be clear on your presentation and what is it that you need from us?
You want to?
Yeah.
So I think what you started saying, though, I think these questions or this discussion could be had, but I think they had a plan and to present, I think we should just let them all present and then we proceed with anything like this after the gentlemen have been able to speak.
Yeah, I have no problem with that.
Okay, that's fine
If you
with us.
said something to
Yeah, yeah.
add.
Why don't we do that? That's fine.
Yeah, because I think there was just a little confusion.
Yeah, and we
with the
appreciate
board.
that, and
Yes.
we hope to clear it up. We'll let the gentleman speak, and then we'll respond.
Okay.
Okay, thank you so much.
Buenos días. Me llamo Jonathan Pérez y trabajo como houseman en el Hotel Figueroa en Los Ángeles, California. Soy miembro de Unit Here Local 11 y estoy orgulloso de ser un delegado para mi unión.
Good morning. My name is Jonathan Perez, and I work as a houseman at the Hotel Figueroa in Los Angeles, California. I'm a proud member of Unite Here Local 11, and I'm proud to serve as a union shop steward.
He trabajado en el Hotel Figueroa desde 2019. Dejé mi trabajo anterior en otro hotel en el centro de Los Ángeles porque quería tener más oportunidades de avanzar. Ahora vivo con mi madre. Mis padres son inmigrantes de Guatemala y con mi trabajo en el hotel yo apoyo a mi madre y a mí. Mi sueño es tener mi propio negocio pequeño.
I've worked at the Hotel Figueroa since 2019. I left my job at another hotel in downtown LA because I wanted to have more opportunities to advance. Right now, I live with my mom. My parents are immigrants from Guatemala, and with my job at the hotel, I support myself and my mom. My dream is to have my own small business.
Desde el último verano, mis compañeros y yo hemos estado luchando por un contrato justo. Siempre he creído que es importante defender lo que es correcto. Muchos de mis compañeros de trabajo han tenido miedo de hablar por sí mismos, pero como delegado sindical y líder de la unión, sé que tenemos derecho a luchar por la justicia.
Since this past summer, my coworkers and I have been fighting for a fair contract. I have always believed that it is important to stand up for what is right. Many of my coworkers have been scared to speak up for themselves, but as a shop steward and leader with the union, I know we have the right to fight for justice.
En este país se necesitan sacrificios para avanzar. Mis compañeros de trabajo y yo hemos hecho huelga muchas veces porque sabemos que merecemos más.
In this country, it takes sacrifices to advance yourself. My coworkers and I have gone on strike many times because we know that we deserve more.
Cuando nos enteramos de que el Hotel Figueroa no iban a firmar un contrato justo como la mayoría de los otros hoteles, me sentí decepcionado. Los manejadores del hotel siempre dicen que somos una familia, pero cuando nos defendemos para cuidar de nuestras familias, no nos escuchan.
When we heard that the Hotel Figueroa would not sign a fair contract like the majority of other hotels, I felt disappointed. The hotel management is always saying we are a family, but when we stand up for ourselves so we can take care of our families, they do not listen.
3 de mis amigos recibieron disparos de bolas mientras manifestaban en el Picket Line frente al hotel. Cuando escuché la noticia me asusté. Nunca pensé que veríamos este tipo de ataques solo por defender nuestros derechos. Pero sé que debemos seguir luchando. No pedimos algo porque sí. Pedimos un contrato justo porque es lo que merecemos.
3 of my friends were shot by ball bearings while marching on the picket line in front of the hotel. When I heard the news, I was scared. I never thought that we would see this sort of attacks just for defending our rights. But I know that we must keep fighting. We are not asking for something just because. We are asking for a fair contract because it's what we deserve.
La,
We just have one more time for translation. Thank you.
That's up to the board. That's, you have a roll limit, so it's up to you if you want to allow him a little more time.
Just a little.
Yeah, we're almost done.
la empresa matriz de VGO, Sun Life, tiene 1.4 billones de dólares. No tiene excusa para no resolver esta disputa.
BGO's parent company, Sun Life, has $1.4 trillion under management. They have no excuse for not resolving this dispute.
Sé que ustedes nos han ayudado a apoyar a mis compañeros del Hotel Figueroa en el pasado. Espero que puedan empujar a VGO a resolver esta disputa para que podamos tener el contrato sindical que merecemos y para que mis hermanos y hermanas despedidos del restaurante puedan recuperar sus trabajos. Arreglar esta situación no solo es lo correcto, también es lo correcto para los inversores y la empresa. Prolongar más este conflicto laboral no lo es. Gracias.
I know that you have helped support Hotel Figueroa workers in the past. I hope that you can urge BGO to resolve this dispute so we can have the union contract we deserve and so that my brothers and sisters fired from the restaurant can have their jobs back. Fixing the situation is not only right, it's also the right thing for investors and the business. Dragging out this labor dispute longer is not. Thank you.
Thank you. Just as a reminder for the board, public participation, if you want to ask questions, you're not obligated to. You can just hear the comments and then move on. That's your choice, obviously.
You had a handout for us?
Yes, ma'am. I do.
Oh, you had?
Yeah, one more. Thank you.
Buen día. Mi nombre es Félix Vanegas. Trabajo como house attendant en el Hotel Figueroa de Los Ángeles. Soy un miembro orgulloso de United Here Local 11.
Good morning. My name is Felix Vanegas. I work as a house attendant at the Hotel Figueroa in Los Angeles. I'm a proud member of Unite Here Local 11.
He trabajado en el departamento de limpieza durante 2 años. Antes de eso fui cocinero en el restaurante del Hotel Figueroa. Estos han sido mis primeros trabajos en los Estados Unidos desde que emigré de mi país, Honduras. Antes de venir a Los Ángeles, trabajé con una organización de derechos de los inmigrantes en Tijuana, México. Siempre he luchado por los derechos humanos.
I've worked in the housekeeping department for 2 years. Before that, I was a prep cook in the Hotel Figueroa's restaurant. These have been my first jobs in the United States since I immigrated from Honduras. Before I came to Los Angeles, I worked with a migrant rights organization in Tijuana, Mexico. I have always fought for human rights.
Yo estaba en el comité que trabajo con mis compañeros en el restaurante para juntarse a la unión. Había trabajado junto a muchos de ellos antes y sabía que merecían los mismos derechos y protecciones que tenemos con la unión. Cuando más de 100 de ellos fueron despedidos de su empresa, me sentí indignado.
I was on the union organizing committee that worked with my coworkers in the restaurant to join the union. I had worked alongside many of them before and knew they deserved the same rights and protections we have with the union. When over 100 of them were fired by the company, I felt outrage. How could a company fire people for standing up for their rights?
¿Cómo podría una empresa despedir a personas por defender sus derechos humanos? Llevamos desde el verano luchando por un nuevo contrato. Es frustrante que el Hotel Figueroa no firme el mismo contrato que ya aceptaron otros hoteles. ¿Para qué están esperando?
We've been fighting for a new contract since the summer. It's frustrating that the Hotel Figueroa won't sign the same contract that other hotels have already accepted. What are they waiting for?
Para mí lo más importante que exigimos es que nos respeten como personas. No somos animales. Es un piquete frente al hotel. Yo era una de las personas a las que dispararon de las bolas de metal. Llamamos a la policía y les contamos sobre el ataque. Les tomó 2 horas responder. Cuando nos dispararon de nuevo, teníamos miedo, así que entramos al hotel por seguridad. El Hotel Figueroa llamó a la policía y respondieron en pocos minutos.
For me, the most important thing we are demanding is to be respected as people. We are not animals. At a picket line in front of the hotel, I was one of the people shot by metal ball bearings. We called the police and told them about the attack. It took them 2 hours to respond. When we were shot at again, we were so scared that we went into the hotel lobby for safety. The Hotel Figueroa called the police, and they responded in a few minutes.
Vamos a seguir organizando protestas, piquetes, delegaciones y acciones para asegurarnos de que la empresa sepa que no tenemos miedo. Merecemos ser respetados, no que nos disparen ni nos despidan.
We will continue to organize protests, picket lines, delegations, and actions to make sure the company knows we are not afraid. We deserve to be respected, not shot at or fired.
Estoy orgulloso de que el senador Bernie Sanders realice una protesta enfrente del Hotel Figueroa hoy más tarde. Es uno de los políticos que siempre apoya a los trabajadores que luchan contra grandes corporaciones como BGO. Estaría en la protesta hoy, pero en lugar de eso vine a hablar con ustedes porque sé que BGO ha escuchado a sus impresiones en el pasado.
I am proud that Senator Bernie Sanders is holding a rally at the Hotel Figueroa later today. He is one of the politicians that always supports working people fighting against huge corporations like BGO. I would like to be at the rally today, but instead I came to speak to you because I know that BGO has listened to their investors in the past.
Dígale a BGO que nos dé el contrato que merecemos y que el operador de su restaurante traiga de regreso a los trabajadores despedidos del restaurante y los bares del hotel. Muchas gracias.
Please tell BGO to give us a contract that we deserve and have their restaurant operator bring back the workers fired from the hotel's restaurants and bar. Thank you. If I can respond to, unless there were more questions or comments.
We really don't take questions at this time. If anybody has a burning question, we hear your presentation, we take information, but I will give you some information.
Okay.
I understand now what you're coming for about us to put pressure on BGO. Or is that what you're asking?
Yes, just to clarify, we're asking for a public letter from the fund to BGO, urging them to resolve the labor dispute and to rehire the workers who were fired at the restaurant. That's what I have public comment here that I can give to you so you all can review it later with documents, the LA Times article and others.
Okay, thank you.
And we appreciate it so much.
Okay,
Thank you.
and I would advise that you contact the National Union, the American Federation of Teachers, the Chicago Teachers Union, unions in everywhere that you can get any labor unions and ask them to join this fight.
Yes, ma'am. We'll do that. Thank you so much.
All right. Thank you for coming. All right, thank you. Do we have anyone else for public participation? Thank you. No. Okay. Okay. Now we're going to move to the roll call. We have 7 trustees on site, and we do have a quorum, so we will call for the roll call. Thank you.
Trustee Barajas,
Present.
trustee Blackwell,
Present.
trustee Nelson,
Present.
trustee Ochoa,
Present.
trustee Price Ward,
Present.
trustee Rodriguez, trustee Vincent,
Present.
trustee Washington,
Present.
and trustee Woods. Do I call trustee Riley?
I can hear you.
Do I call trustee Riley?
Well, we're gonna do, let's do the action to approve the remote
Approve them.
attendance. For we have trustee Riley, and actually trustee Woods is on as an attendee, not in as a panelist. So we may want to upgrade her to panelist.
I'll give her a few minutes to upgrade, and then I will start that process. The vote to approve the trustee remote attendance and full participation. She's on, okay. All right. The Open Meetings Act allows for the participants by a trustee if a quorum is physically present, which for the committee is 7 members, and a member cannot physically attend due to personal illness or disability, employment, public body business, family, and other emergencies or unexpected childcare obligations. Trustees Mary Sharon Riley and trustees Tanya Woods have indicated that they will be attending this meeting today. Trustee Riley, please state the general category of the statutory exception for the remote attendance and confirm you meet the requirements under the OMA.
I guess I do. I was in the hospital for intensive care for 2 weeks and then in rehab for 2 weeks. So I had pneumonia.
Okay, thank you, trustee Riley.
And that does qualify, obviously.
And
I
that
sure does.
does qualify. You- I was saying, we could have stopped it. Okay. Trustee Woods, please state the general category of the statutory exception for your remote attendance and
Care for a
confirm.
parent.
I'm sorry, say again.
Care for a parent.
Okay, thank you so much. That qualifies. Okay. Thank you both for attending remotely.
You're welcome.
All right. I will now entertain a motion and a second from the trustees who participate in person, allowing our trustees attending remotely to fully participate in the meeting.
So move. Second.
Okay, thank you. We have a motion and a second. Please call the roll of all members who are participating on site.
Trustee Barajas, trustee Blackwell,
Yes.
trustee Nelson,
Yes.
trustee Ochoa,
Yes.
trustee Price Ward,
Yes.
trustee Vincent,
Yes.
trustee Washington.
Yes.
Thank you. You want to vote?
Would you like to take, please?
You wanna-
Okay.
Would you please take, did you take?
Trustee
Trustee
Barajas, your
vote?
vote for this.
Okay, thank you. The motion was passed and trustee Riley will participate as well as trustee Woods will participate in the meeting. We will now move to item number 4, approval of the minutes. Okay,
Second.
thank you. She moved it and seconded. I just love y'all.
I don't get to make motions. This is my
This,
day.
this is his day to make some motions. All right.
Roll call.
Yes, roll call, please.
Trustee Barajas. Trustee Blackwell.
Yes.
Trustee Nelson.
Yes.
Trustee Ochoa.
Yes.
Trustee Price Ward.
Yes.
Trustee Riley. Trustee Vincent,
Yes.
trustee Washington,
Yes.
trustee Woods.
Yes.
I'm sorry, I was muted.
Okay, your vote is?
Yes.
Thank you. 9 ayes.
Okay. That was the December 1st, 2023 minutes. Thank you. We had the motion and the motion passes. I will now entertain a motion and a second to approve the February 2nd, 2024 Investment Committee First Friday minutes.
So move.
Second. Okay. Thank you for the motion and second. Please call.
Trustee Barajas,
Yes.
trustee Blackwell,
Yes.
trustee Nelson,
Yes.
trustee Ochoa, trustee Price Ward,
Yes.
trustee Riley,
Yes.
trustee Vincent,
Yes.
trustee Washington,
Yes.
and trustee Woods.
Yes.
Thank you. 9 ayes.
All right, thank you so much. The motion passes. So now we will move to item number 5, the First Friday presentations. Thank you, and we will now move to the presentations, and I will turn the meeting over to our investment team and Callan, our investment consultant.
I'll start off, trustee Price Ward. So good morning, trustees. Today we have invited 4 Chicago-based firms to present before you. 3 of the 4 are currently managing assets for CTPF under several asset classes. Also, 3 of today's presenters are in the market with their latest fund offering. So we're interested in hearing what opportunities they see in their respective markets. Today's presenters are diverse from an owner perspective, but also from an asset class perspective. We will hear about real estate, infrastructure, private equity and domestic, international equity, and fixed income. And as a reminder, the purpose of First Friday meetings is to meet new managers, gather information. There will not be any recommendations, selections, or decisions today. Our first presenters are senior members or the team from Addix Asset Management. Addix has been managing assets for CTPF for a while now. Currently, they are managing about $270 million in CTPF assets with an allocation that closely mirrors ours in domestic equity, international equity, and fixed income. And the purpose of inviting Addix today is to have them provide an update on the firm, provide a quick review of the portfolio, and perhaps shed any insight on what management plans are given recent personnel turnover. And so with that, I will ask James Binsfeld to invite a guest in from Addix and make the introductions. Thank you.
Good morning. Welcome. Yes.
Good morning and welcome to Chicago Teachers First Friday. With us today, from left to right, we have Trustee Barajas, Trustee Vincent, Trustee Nelson, Trustee Washington, Executive Director Lenore, Trustee Blackwell, Trustee Price Ward, and Trustee Ochoa, our Chief Investment Officer, Fernando Vincents, our consultants from Callan, Brianne Weymouth, and Bernie Bazil, along with investment staff. You'll have 25 minutes to present, followed by 5 minutes for questions, and you may begin your presentation now.
Before we get started, I just wanted to check if
Pull your-
Karen
then
Mayer,
pull your mic up a little.
before we get started, I just wanted to make sure that Karen Mayer, who joined remotely, is also available. Great. Thanks.
Yes, I'm here. Thank you.
Good morning. Okay. I'm Les Bond, the founder and CEO of Addix Asset Management. It's been quite some time since we had an opportunity to be before you. So it's great that we've gotten COVID behind us and we can meet in person again. If you turn to page 3, I'll start the presentation. Page 3 really is a history of not just addicts, but also the trends that we see that are major themes in the emerging manager space. I think, you know, just to talk about the emerging manager space in 2024, my own view is that the space is evolving, but as it has been for the last few years. And as a firm, we have been evolving too. We took the opportunity to buy another firm just like ours in 2020, and that's how Karen Meyer came to us from Capital Prospects, and she heads our fixed income efforts as Benny heads our global equities. So we made that change last year at the beginning of the year when Pat Silvestri left us, and we split the responsibilities for fixed income and global equities into 2 heads, which made sense. 44% of our assets are fixed income and 56% are global equities. Our strategies, you can see how our strategies have evolved over the time. And we are also undertaking efforts at diversification in our offerings and looking at private markets. We have the approval from one of our clients, the Pontiac General Employees Retirement System, for an affordable housing fund of funds. And we brought with us today Sinclair Nagy. So we asked him to come today. If you have questions about that strategy, about our affordable housing fund of funds, but we are also working through Karen's efforts in the private credit space. So we are evolving and we're still growing. If you turn to the next page, you can see our AUM total at 4.2 billion and the different strategies that make up that total AUM to the far right. It has plateaued somewhat, but it's not because we don't see any lack of opportunity. We do see new opportunities coming into the emerging manager space. And ideally, most of those, well, not most of them, but a great significant portion of those is in fixed income. And Karen is doing a great job managing those portfolios for us. On page 5, you'll see the addicts team. You'll note that Winston Blake is no longer with us. He was our president. He left at pretty much the end of the year to really look for opportunities, entrepreneurial opportunities in the space. I think it was an opportune time for him. I started addicts when I was 40 years old. Winston's in his mid-40s. And it just seemed that he wanted to really go into the private market space and explore opportunities there. It's always difficult to try to reinvent yourself and to bring new strategies to the marketplace. And we're moving as we feel quickly as possible. But the opportunities, as you know, as trustees, you see all of the hottest efforts in terms of investments. And private credit is a very hot space, as is private equity, as it relates to the MWBE manager space across the country. We will miss him, but we've already filled in. As you'll see at the very bottom, we have a new investment analyst, Eli Rosenfeld, has joined us. And we have a new quantitative analyst joining us in June when she graduates from college. And we were very fortunate to have Sarah Mongerson join us, a 33-year veteran in the emerging manager space. And she came on just this week. So we're very fortunate to have found some great candidates to come in and to work with us and to build out our team. Any questions?
Yes, go right ahead and ask that one. We usually save the questions for the end.
Okay.
But
He just mentioned the college, that he's finding, good persons to come in. What college are you using?
Lake Forest.
Lake Forest. Okay,
Yes.
because a lot of our managers can't seem to find the talent.
Thank you so much, Lois. All right, so going forward, we're gonna save questions. till
Okay,
the
we'll save the
end,
questions.
we'll proceed.
Okay, I'll turn it over to Vinny.
Let's flip to page 6. And we'll just start with the team that's been servicing your account. I'll start with myself. I've been working with addicts for 17 years. In all 17 years, I have worked with the Chicago Teachers account. So I have all the skeletons and what's happened with the portfolio and how it's evolved over the years. We evolved from a all cap mandate, and then in 2013 graduated into a best in class or best ideas mandate with the idea of trying to mimic a bit of your asset allocation and find new opportunities that you can invest in directly in your allocation, but that also work. And also on my right side, we have Joe Stelmezik, who's worked with CTPF for a while, starting as an analyst, now as a VP, and he handles all principal communications with the plan. And Cesar Delatour, our analyst, who's been with us for 3 years. It seems like yesterday, but he's now our most senior analyst with the firm. Flipping to page 7, I just wanted to quickly, I know you all know the benefits of using emerging managers, but I wanted to highlight just some of the key things that we look for. We're looking for firms with cognitive diversity, as well as firms that have that entrepreneurial factor. They understand not only how to invest money, but also run a business. And so we have to see both sides of that. So that's what kind of is our niche in understanding the space and working with firms, especially newer firms who are just starting up. We think firms that are smaller, just starting, have an advantage of being nimble and the opportunity to outperform in asset classes that are constrained via capacity and have inefficiencies as far as coverage. And so there are many opportunities there. We're pressed for a little time. I want to keep moving on page 8. It just talks a little bit more about how we focus on smaller and newer firms. One of the pieces on this slide that I wanted to highlight is the chart at the bottom left. It's our annual meetings, and we track our meetings. We've typically had around 160 meetings with emerging managers annually. Just this year, we've seen an uptick. We're up to 80 meetings this year, newer firms, introductory meetings. So we're excited to see that. We saw a little lull between 2020 and 2022. We all moved to the virtual meeting, so we don't think that was a factor. We're seeing new firms come into the space and people jumping out to do their own thing, and exciting. We're seeing some exciting new strategies, people with their own take on how to invest within US small cap, international, and fixed income. And with that, I wanted to turn it over to Karen, because I think we all talk about equities all the time, but I wanted to make sure we discuss fixed income, that portion of our portfolio a little bit later, but just some of our capabilities and opportunities there.
Thank you.
Karen?
Hello, just want to make sure everyone can hear me.
Yes, we can.
Okay. It's been wonderful to have capital prospects acquired by addicts, and exciting to see our team evolving and growing. And we continue to build out that client service pyramid. And we've added some great talent across the board, but also in fixed income. So the thing I want to emphasize most about the emerging manager universe in fixed income is the quality and depth of the talent. The intellectual capital in this space is really impressive. And for our 1.7 billion in assets under management in fixed income, over 95% is with women and minority-owned firms, and that is out of merit. In our research process, these firms really rise to the top. The strength of their ideas, their consistent, proven ability to add value with favorable risk-adjusted statistics. It's a very impressive space. It's a pleasure to get to work with these firms and to bring them more assets. Most of them should have way more assets. The thing about fixed income, though, is the markets are inefficient, and you don't want to be too big. for certain strategies. There's a lot of value to be added as a small, nimble manager in fixed income because of the decentralized nature of the markets. There are market dislocations that arise. We've been in the midst of lots of market volatility with the Fed and inflation. There's always risk on and risk off periods that come, and sometimes it's in reaction to the latest statistic. Sometimes it's wild swings in investor sentiment, as we've seen, and the smaller firms can be very nimble in these periods. We've done research. I know we're pressed for time and I won't get into this now, but just looking in investment and looking at outperformance by asset quartile, the smallest firms have solid outperformance metrics against their larger competitors in areas such as, corporate credit, high yield, and some of the sectors, mortgage-backed securities. So the main point I want to get across is we have a deep and talented team. We spend a lot of time with emerging managers, getting to know them and understand how it is they add value for clients, dissecting the risks taken, and then how those risks translate into alpha. We want to see that consistent outperformance and to really dig in and see how these smaller firms can outperform. What is their unique approach in intellectual capital? Many of them have really strong track records and talent. I would put them up in active management against the top names. And so we like to take the depth of talent we have found and we partner with our clients. Everything we do is based on our clients' objectives in fixed income. So in portfolios like yours, there are some strategies that we're seen as unique emerging manager strategies to add value in those portions. We have other clients where we're a big part of their fixed income allocation, and it can be very geared towards the Bloomberg US Aggregate Index, their policy benchmark. We have structures that are purely best ideas, like just the top performing managers in fixed income, regardless of benchmark, and then having a customized benchmark. So I would like to emphasize that the talent out there is very strong. We can partner with you to meet your needs as appropriate, as we do for all of our clients, and some of the sector talent, in addition to the core and core plus, is very, very strong in this space.
Great. And one success story, and Cesar's going to talk a little bit about that, but just to Karen's point, we recently had a graduation from our portfolio, Ramirez, into your Core Plus strategy, and we were able to hire another exciting firm, Barksdale, in Core Plus here, and then we have two other managers that we'll talk about a little bit later in fixed income. Just really quickly, in the interest of time, just slide 12, I just wanted to make sure Karen hit on most of these points. Our philosophy is consistent across equity and fixed income and what we're looking for in firms that we work with. We talked about that cognitive diversity. We want to also make sure they have a consistent philosophy and process that's been tested over time, and their portfolio management and approach is rigorous. We want to understand their buy-sell decisions and how these firms work, because we're building portfolios of complementary managers. So we want to understand what their core competency is and how they're going to work alongside another manager that's within that portfolio. So it's a lot of art and science in what we do, but the art part is the fun part. We all enjoy the quantitative and understanding the numbers, but getting behind the numbers is our sweet spot and kind of where we stand out. The next page is our manager pathway. I think you all have heard this before, but just how a manager goes through our process from soup to nuts. We obviously meet firms at conferences. First Friday has been a huge opportunity for us to meet with firms over the years. Ever since you've been doing it, we've been joining the meetings, and we've met a number of firms, if not They were meeting with us at the same time they were here to present with you. So it's always good to see that consistency and also be able to refer managers for you all to meet that we've really liked. And there may or may not be an opportunity in the portfolio, but just to see them develop over time. I'll turn it over to Caesar to talk a little bit about some of the successes in the portfolio, some of the good stories. And this is a caveat. This is since we moved into the best in class, or what we're calling multi-asset strategy. There were some successes in firms that were acquired before that 2013 period. But I'll turn it over to Caesar.
Good morning. It's a pleasure to be here. First and foremost, one of our main goals is to deliver alpha, of course. But secondly, we want to work with minority women-owned businesses and essentially give them the opportunity to grow, compete, and eventually one day graduate within the client. So we thought it was very important to highlight just a few managers that had some success as far as CTPF helping the managers and as well as graduation opportunities. Just starting back in December of 2013, after the transition to the multi-asset strategy, CTPF actually was a first funder to Brown Capital with their international small cap strategy with an allocation of $13 million. As of February 29, 2024, the strategy is at about $3 billion in AUM. So it really kind of shows the support from CTPF. And then just a short 2 years later, CTPF was also a first funder to the Global Flex Capital and their global strategy. And they're currently outperforming about 160 basis points inception to date. And just touching a little bit on the graduation aspect, in 2016, CTPF graduated 2 of the existing managers in the portfolio. Asian American-owned focused financial small cap value strategy, and then strategic global advisors international developed strategy. And both managers have been doing extremely well within the portfolio since graduation. And then moving on to February of 2019, CTPF was not a first funder, but an early funder of Herd Capital. Their long only concentrated all cap core strategy. With the 20 million allocation since then, the strategy is at 1.6 billion and is now their flagship strategy. Herd is actually coming off one of their strongest years in 2022 or 2023. They were up about 20% against the benchmark. And lastly, as Vinny kind of touched on, it was Ramirez, Hispanic-owned Ramirez Asset Management, fixed income core. He graduated in 2021, and they continue to deliver alpha for you all. So I just want to highlight the importance of this program, and we're sticking to our guns, and I'm sure the managers appreciate the support of CTPF staff as well. So. With that, I'll pass it to Joe Stelmazek to kind of dive into the portfolio a little.
Morning. Thank you for your time. I'm here to cover the portfolio, the managers, any questions you guys have, but I'll briefly touch on the managers and give a quick overview. Please stop me with questions if you have them, but Caesar already covered some of this, but Herd Capital, they're African-American owned, Chicago-based. They've been doing very well since being added to the strategy in 2019, and their growth of their now flagship strategy, the long only, the concentrated long only high conviction strategy. Paradigm Asset Management, we actually have the 2 strategies of theirs in here, the large cap value and the international large cap core. They're an African-American owned firm based out of White Plains, New York. A quantitative based firm. You get beta, they're like an enhanced beta manager, the diversified with factor exposures, factor tilts. The Lasanti Capital Growth, it's a woman-owned firm based out of New York. She manages the small to mid cap growth strategy. And it's a strategy that has a thematic overlay, and she's really looking for, it's a high beta strategy. She's looking for names at the forefront of structural technology and demographic changes. Brown, we've touched on, Caesar touched on a little bit, but they're African-American owned, based out of Baltimore. The international small cap growth strategy is the one that he mentioned, has grown to over 3 billion from CTPF's first funding of that through ADDX. Glovista, the emerging market strategy, Hispanic owned, based out of New Jersey. They are a top-down thematic manager, investing through ETFs, and then Globeflex Capital, sorry, Globeflex Capital, a woman-owned firm based out of California, and they have the global unconstrained strategy. And then the fixed income managers, we have New Century Advisors with the Global Tips. They're a woman-owned firm based out of Maryland. Barksdale Investment Management, which Karen touched on, the core plus fixed income. They're based out of Tennessee and they're women-owned. And then LM Capital, the EMD strategy, they're Hispanic-owned and based in California. I just have, sorry. Do you guys have any questions related to the portfolio, or I can talk more about the performance, the allocation, or we can dive into any of the managers? Oh, great. So we touched on the managers' ownership. So looking at performance, the portfolio, the total portfolio has done well overall since inception to date. For over a 10-year period, we are outperforming gross of fees and a little bit behind net of fees. And it really has been due to the past 3 years. There's been some market dislocation, but the market not trading on fundamentals. And some of our growth managers took big hits in 2022. But you can see we are making that up as growth and small cap sold off. And they're now that fundamentals are coming back into focus, our managers like Lasanti, Brown, and Redwood are making up ground quickly. And then touching on the managers, you see in the inception date column, the last column on page 17, Hurd, like Caesar mentioned, they are ahead over 200 basis points annually for the over 5 years since they've been in the portfolio. Paradigm is also outperforming large cap value strategy. They've been in the portfolio since before the transition to the best in class portfolio. Lasanti struggled during 2022, but making up ground quickly. Redwood, international core manager, outperforming since inception for the over 6-year period. And then Paradigm's EFA strategy, it has struggled lately. We are looking closely at it. The one market where they don't do well in is a rapidly changing market. They have kind of a lag with their portfolio construction process. So the past couple of years, I know you guys have heard it multiple times. There's been narrow leadership in the market with a few names driving returns. Small cap, the technology has, 2022 technology led the market down, and then 23 led it up. So it has been a rapidly changing market. So we don't expect them to do well. This is the one market we don't expect them to do well in, but they have been struggling for some time. So we are watching them closely. You want to
Thank
ask
you.
questions?
Now we will open it up for questions.
Sorry.
I'm sure we have plenty of questions.
Yeah.
I have one question to start us off. Les, you talked about, you have a gentleman here that is an expert, or you're a guy for fixed for affordable housing. So later on, you have questions, but we very much would like to hear from him with whatever projects in affordable housing, especially if they are here in Chicago.
Sure. Sinclair, you want to sit in for me and tell them about what we're doing? Yeah, to turn the mic.
Good morning. Thank you for having us this morning. My name
Good
is Sinclair
morning.
Nagy, and to kick it off on affordable housing, so we have made this initiative into private markets based on the growing segment of affordable housing, where we've seen the market trends where there is a need for both low income housing as well as workforce housing. It's been a growing trend for probably the past 20 years. And so historically, what we've seen in that trend is in the past, it's been predominantly invested in by banks as part of the Community Reinvestment Act. You know, they are required to allocate certain amount of lending to affordable housing initiatives. Now, we've seen an uptick in interest from institutional investors in recent times, as this is a growing segment of the market. Like I said previously, banks have invested more for regulatory reasons. However, there is a pretty good return profile for many of these projects, and so it garnered the interest of institutional investors. As of right now, still the largest group that invests in this segment is banks, with the second largest being pension funds, endowments, and other institutional investors. What we noticed really is historically, preservation of affordable housing has been a key theme, meaning that communities like Chicago even have experienced places where maybe a neighborhood has lower price housing, where they're able to go in, acquire a house, and then renovate to bring it up to called modern standards while still retaining the affordable nature of the house. Now, this can be achieved through many avenues, but a couple of them that I would highlight is some of them, there are subsidized approaches. Low-income housing tax credit is one you may have heard before, where managers will basically get allocations of tax credit from the federal government. They'll go out and basically raise a fund where investors in it benefit from this low-income housing tax credit, where they can offset their federal taxes, and basically it makes the manager, gives the manager an opportunity to make the renovation of the affordable housing units economical. As you can think about it, when it comes to affordable housing, the difficulty is that you're trying to keep the prices low while you're still operating in a real estate segment that is pretty pricey. So some of these subsidized programs like the low-income housing tax credit, as well as more tenant-focused Section 8 vouchers help these managers make these projects economical, as well as we've seen an uptick in what we call the naturally occurring affordable housing, which is basically, once again, neighborhoods that just need a little bit of renovation in order to make them more livable, modern, and enjoyable for the community. Now, there is another element to this affordable housing, as we've seen it, as not just the return, but it's also the social impact of it. So many of these managers that approach this space also focus on their economic impact in terms of improving the tenant's life through various programs, such as, let's say, reporting unpaid rent to credit bureaus to build credit history for the tenants, as well as we've seen managers that renovate their units by offering, for example, daycare within their own multifamily units, because they'll take out things like the pool or the gym, because maybe tenants are not requiring that, but they'd rather need something like daycare. So we've met with many managers that approach it from this multifamily housing approach, where they give these amenities to the tenants, as well as we've seen some managers that approach it from a single family residential approach. So we've seen more on the multifamily side, but there's examples of single family as well. What else? Honestly, what we see for the future now is the preservation of affordable housing is still a very strong trend, but now there is an expected uptick in new development. there are certainly incentives for that as well. This low income housing tax rate applies for both preservation as well as new development of housing. And so at this current juncture, where we are is, as our founder Les has mentioned, we have a commitment from one of our existing clients for an affordable housing fund of funds. And so at this juncture, we are meeting with managers. We built a very strong roster, as I mentioned, multifamily, single family. And not only that, but we also have capabilities both on the equity and on the debt side. We have managers that have operated in the debt side where they target certain areas to be able to bring lending back to those markets. So there's a multitude of layers here that we can approach this program with. The idea here is that we see this as a growing segment, and we think it's the right opportunity to be able to do something where it's not just a return-driven approach, but also a socially impactful method.
We have a question from.
So,
trustee Rogers.
Good morning. How are
Good
you?
morning.
So I like all of what I just heard, and I have some questions. Couple of questions. When you talk about development, because when I think about affordable housing, I think about rents that are affordable, that are not being driven up by corporate greed.
Yes.
Because that's one of the issues I think that's happening in Chicago in particular, when you go into certain communities that have been disinvested in, and the properties have been bought for rather cheap, renovated rather cheaply, and then price gouged, then the rents are price gouged, and it pushes people out of the neighborhoods essentially, especially depending on where it is, right?
Yes.
And what may be on the horizon in the larger, planning thing. So I guess my question is, as you're thinking about development, what does that development look like? And within this development, I know it's a fund that's about making money, and we need the money, the things we're invested in, because we need to get, pay benefits. And I will be a beneficiary in about 12 years, and I'm not going to understand if the money not here. So I get that. And how are we doing, or how is it that you all are thinking about the development in a way that stabilizes communities, but also offers opportunities maybe through condos or some type of a mortgage product or something? I don't know. These are just things off the top of my head that would be stabilizing to communities where people are building wealth within communities. Because when people are invested in their home within a community, that brings a certain amount of stability for the community as a whole, versus a transient situation where people live somewhere for a couple of years until the rent becomes unaffordable. Now they're moving on, and then somebody else is coming in, and it's a cycle of movement. So as you all are thinking about or investing in that space, actually, I guess I didn't have a question. It's a statement. So I would like for you all to be thinking about how can addicts lead in that space where you're balancing rentals and ownership? Because again, in America, one of the biggest things that we invest in is where we live. That was a part of the original American dream, and that dream has become a nightmare for some people because they can't afford it. Chicago is still a relatively affordable city in comparison to other larger cities, but how do we keep that where working class people can still find a way to own a home or a condo or something? So that's the question I basically have. Like, what type of an event? And I don't know the answer, and you may not know the answer today, so it's not to put you on the spot, but what can be developed in that space that still makes money, to the point that you made about renovating, but keeping it, the cost reasonable, but still profitable. So how do you balance that in a way that, has some rentals, but also has some ownership opportunities? Because I think I would hate to see us in a society where the only people that get to own their home that they live in is, the people that are in the 1%. But regular working people that are keeping the economy flowing, that are making the 1%, are renting from the 1% essentially, and at the mercy of the people that own all that stuff. And honestly, sometimes that's what I feel like we're headed.
Sure. No, that's a very important problem, as you pointed out. So, purchasing a home now is becoming harder and harder for everyone.
Mhm.
So the way we look at that is we try to first evaluate the manager's approach to see what the social impact will be from that aspect. I mean, as you mentioned, return has to be there. But then as another layer, what we put on is to make sure that the manager approaches in a way that does create wealth for the individuals. So an example for that is the single family residential manager that we have met before. Their example is they have a program called a rent to buy. So basically, they will have tenants in these single family residentials where they will rent. In the meanwhile, they provide a financial coaching program for them within their community where they'll help them make sure that they are able to save down for a down payment. They even offer down payment assistance. And ultimately, the goal is to lead to the ownership of that same single family residential unit. So that tenant may be there for a few years, after which they may actually become buyers if they're basically taking advantage of these programs. So that's one way we're looking at it, where not all managers do this, but again, we have examples of managers that do approach it with the mindset of trying to lead to ownership, so therefore creating wealth for these communities.
Okay.
Trustee
Trustee Nelson.
Riley.
Oh, I'm sorry, Trustee Riley, and then Trustee Nelson.
Thank you. What income levels is considered in affordable housing?
Sure. So I would say there's kind of two ways of categorizing them. It's always going to be based on area median income. So when I say AMI, is just referring to area median income. When you think of truly affordable housing, that's generally speaking below 80% of AMI. So households that earn less than 80% of the area median income should be able to afford these units. More often in the past, what we've seen is banks happen to invest more so in those because obviously the returns are more difficult to make in those units. But there are ways managers are coming up with innovative ways to increase the return profile of those units. And then what we would consider as a second category, that's more of a workforce housing, which would be considered between 80% and 120% of area median income. So think of teachers, firefighters, police officers, workforce housing. That's basically—
Right, that's what I'm asking. What would it be around here?
So I don't have the area median income readily available at my hand right now, but we would look at the published area median income for the area of Chicago, and then from there, the manager will determine if they're targeting that 80 to 120%, which would be the workforce housing, or if they're targeting housing for less than 80%. But that's really generally the two categories we would put it in. So I can follow up with you on the exact number of what the area median income here for Chicago is, but that's the driving factor.
Thank you.
Yeah, I mean, I
Nelson.
have some personal experience right now because I have two nephews who don't own anything. And one's 36 and the other one's 31. The 36-year-old is married and they're first starting to look for a house. And like around certain areas, I was pretty unaffordable. I mean, they're looking up in Lake Bluff, which is a more affordable North Shore community. But they have two incomes too. So I don't know, it's different. I mean, but they're not
Trustee-
rushing out to buy houses either.
Yeah, it's potentially generational change as well, but I agree that it's just getting harder to acquire a home now. So,
But mentioning that, I have a couple of cousins who are like 10 years younger than they are. The first thing they did was buy a house when they were single
sure.
in the city on the northwest side.
And I'm sure they're thankful for it now.
Oh, yeah.
Thank you. Trustee Nelson.
Thank you. Okay. Trustee Ward, my observation precludes your question regarding the housing. So I'll go back, okay? And the idea is that I was on the board in 2005, and that's when addicts was in the fund to fund. Am I correct in that?
Yes, ma'am.
Okay, and you graduated at that time, correct? At any rate, and so I'm just impressed. I mean, we're not making decisions about anything today. So I can just say that I am impressed that Addis has pulled forward others through the graduation process. That was something that started here, at CTPF. And I'm just really impressed. And I wanted to say that today when we're not, evaluating for anything. This is the time to throw the roses out, okay?
Yes, it is. Yeah.
All right. Thank
I
you.
agree with you.
Thank you
Quite
for that.
impressive, quite impressive. Any other
Further
questions?
recognition.
Okay, Paula?
Hi, so I do agree with what trustee Nelson. And so I see in your, go back to housing, so sorry about that.
No problem. Happy to talk
Yeah,
about
I
it.
see you have, kind of a low income strategy, right? And also want to go back to trustee Riley's, like really taking a deep look at the AMI workforce housing, right? Because here in Chicago, we have public servants, teachers, firefighters, police officers that live in the city and are required to do so. And so, and many times when you look at what's that magic number, right? That you're gonna do the 80 to 120%, it's so much higher than any of us really make that we're wondering like, where are they getting this number from, right? So, when you look at a manager who's doing that, like really have them dig deep into that number and not have it be driven by the higher end teachers and firefighters and police officers are getting paid, because we're also trying to attract, right, more into the workforce.
Yes.
So, and I know we're as Quentin said, we're here to also make money for our fund, but also do long-term money making in terms of investment. So, I would urge you to please sort of think about that, because you have a low income sort of thought frame mind right now, but this middle income workforce, whatever you want to call it, like they are crying out for affordable housing right now. And so that's a market that wants you to help them. So thank you.
Just in response to that, the managers we have met with as we build our roster, and it's probably been about a 50-50 split between the managers that do target what I would call the low income housing, as well as the other half is probably about the workforce housing. And so what you will experience in those strategies is the LIHTC, the low income housing tax rate, is more often utilized for those low income communities. And then the naturally occurring affordable housing is what I would refer to with the workforce housing. So we have seen roughly an equal part in both of those approaches. So
and you stabilize a community that way, right?
That's
So
right.
you talked about stabilizing a community, right? You stabilize a community when there is a mixture of both low income and middle class or workforce, right? That's how the community becomes stabilized.
That's right. Oftentimes it's part of the investment thesis. I mean, that's what they end up going in with. Is it's not just the idea to acquire a low-cost property and then maximize returns, but to actually be able to revitalize the community for the purpose of, honestly, if you look at it from an econometric standpoint, if you revitalize one community, there's spillover effects into the next. And so these managers try to look for it in a way where they can build these building blocks, not just as a single investment, but one investment will lead to another, and so on and so forth. And so the idea here is not just do it once, rinse our hands and done. It's to build a long-term impact. And these funds represent that trend.
Trustee Price, oh, sorry. I know, I didn't realize another trustee had a hand up.
Yeah, trustee Ochoa is next.
Just a quick comment. It's gratifying to hear that you appreciate the First Fridays and you've taken on those efforts too on your own. And yeah, it's just always good to expose everyone you can to diverse and up and coming organizations. So it's appreciated to hear about that.
Thank you.
Trustee Price, I think James wanted to address the board at this point.
Yes, James.
Thank you, Trustee Price Ward. And gentlemen, thank you for your presentation. For the benefit of the audience, could you just quickly take us through your philosophy and process across the asset classes regarding the MWDBE brokerage in terms of maybe the evolving landscape of who you've seen in terms of the industry stalwarts and perhaps some of the brokers maybe that you're considering going forward?
So when it relates to the affordable housing strategy, brokers is not the same term as you would expect it in, let's say, public equities or fixed income, where there's trading going on. We look for it more through the manager itself, whether the manager itself is an MWBE firm, and then who they utilize as their local partners. So when it comes to those brokers, we do try to find managers that also emphasize on the usage of MWBE local partners, such as, it might be a local broker as well as a local developer. But basically, our philosophy at this stage is you look at it through making sure that the manager is not just in it for the profit. They are trying to build the community of the MWBE local developers. When I say that, it could be, let's say, one of our firms, and I'm not sure actually if I'm allowed to say names perhaps, so I'll do it anyways. One of our managers is M Squared that we have a meeting with. They are a New York-based developer who looks for affordable housing managers, and it's a women-owned organization. So not only the manager ends up benefiting from this and builds the local MWB community, but then the underlying assets that they are trying to invest in will serve those communities as well. We also have that single-family residential manager that I mentioned, where they are trying to work with the local developers as well as the local, just basically partners, that they are trying to make sure that there is a certain MWB element to it. It's difficult. It is difficult, to be fair, because oftentimes these segments are limited. You know, it is a smaller asset class than the real estate overall. But nonetheless, our philosophy is really just to make sure that the manager is not just in it for the profit. At the end of the day, there is a social aspect to this.
And James, I just wanted to clarify if any part of your question had to do with trading of the portfolio. Okay, and I'll address that part also.
My apologies. I misunderstood.
So we've long worked with MWB trading partners. I think you all know some of the bigger names, especially in Chicago. And I think you all have done a great job of meeting with and approving that list of international domestic equity trading brokers. I think you know them all. So I don't need to educate you all on who those names are. I think one of the things that we look to is the list that you all provide as approved list of MWBE brokers. And that's a source for us. We share that with all of our managers, even who are not managing money for CTPF, just to make sure they're engaging with the firms on that list. I'd say we haven't seen a lot of new firms, but we've seen them develop their capabilities. So developing their overnight desk for small cap, international small cap trading and transition management. We typically utilize, I would say 50% or greater with MWBE. Some of our trading brokers, we offer that as a goal to our firms. And some of the more inefficient or constrained asset classes like international small cap, we tend to have a 5 to 10% goal. And we look to see the firms that we work with improve that over time and not just meet the goal, but try to exceed that and develop relationships with those firms.
Yes, trustee Vince.
Oh, thanks. Thank you. So I just have I guess a theoretical question. Now that DEI is like such a negative term, will it or has it impacted, your investment strategies or anything else strategically? Or has it brought in more opportunities for you guys to engage with emerging folks who may not be given that
I can respond to that, but Les will probably give a better answer, but
it's there. I think it started with ESG. And it is the most political, it is the largest politicization of investing, institutional investing that I've seen in my 23 years of business. But I don't think you can put it back in a box. I think my own view is that if it continues to move in the direction of ESG, if DEI moves in the same direction as ESG, that our clients, the clients that we have, will double down. I find it very difficult to believe that it has the same outcome as ESG, because diversification is the touchstone of investing. And we have science that demonstrates that cognitive diversity in the decision-making for investments adds alpha. And so I hope, as I do with a lot of things in this country, that science will ultimately rule out the politicization of what we see as our task of demonstrating that smaller entrepreneurial firms with cognitive diversity in the process can outperform.
Mhm.
Trustee Riley has her hand up again.
Okay. Oh, okay, trustee Riley. Trustee Riley,
She's on mute.
She's muted.
you need to unmute your mic, trustee Riley.
No, she's gone.
Yeah, okay, we'll send her a text. Trustee Riley,
She got disconnected.
Yeah.
oh, okay. She hit the wrong button.
You got a question in the back.
Yes, please.
Good morning. Just wanted to bring to the board's attention. We had an early on conversations with addicts to maybe look at rebalancing the portfolio a little bit. It's a little bit over allocated to international and global compared to what the CTPF portfolio is right now. So we just asked them to kind of take a look at things and maybe move some money around. But on the topic of that, I was wondering, do any of the candidates, or rather the managers in the portfolio now, do any of them look graduation ready? And secondly, with respect to the affordable housing that you're bringing on, is that, would you consider that product, I guess, mature enough to add to investors, or are you kind of sticking with just the one investor, I think it's Pontiac you mentioned, to kind of, get your feet wet and kind of figure things out? So curious about those.
Look, I'll take the housing question first. It is ready. We have been doing this research for more than a year. It's everything about every portfolio that we have is customized. We customize everything to the desires, wishes, goals, investment goals of our clients. So we have interviewed not just funds that invest in affordable housing, but we have also done interviews with firms that provide strategic purchasing of mortgage-backed securities in zip codes. You can dial it into your zip code. Karen has been doing this research. Karen, do you want to talk about that aspect of our affordable housing strategy?
Sure. The U.S. agencies that issue mortgage-backed securities since the financial crisis have really extended their outreach to help people in their homes for down payment assistance, et cetera. And while it is a smaller proportion of the publicly traded mortgage-backed securities market, which is a huge market, it's trillions, there are smaller managers who specialize in this. And so they're able to target U.S. agency securities that have no credit risk because they're guaranteed by the full faith and credit of the U.S. With mortgage pools that are focused on certain neighborhoods or certain mandates. So it can be zip code based, it can be affordable housing based, it can be geared towards foreclosure prevention. And the managers are small managers, and they can customize to client profiles and make sure you're getting the proper diversification still in your portfolio. So there are both public and private ways to work on the housing issue, and small managers can have a very strong offering in publicly traded mortgage-backed securities that meet these goals.
Thank you, Karen. We are way over, but real short.
You said 15% of your portfolios in healthcare. I guess I'm not understanding exactly what does that mean in healthcare? Where? On page.
Oh, those
this is
are
old, page 19.
That's the sector exposure of the equity managers in the portfolio. So among the total portfolio of equity managers, 15% is within healthcare. You'll see the list down of the 12 GICS sectors that are represented. This is just the exposure in the equity portfolio. Yes.
Yes. And that's spans across medical devices, pharmaceuticals, maybe some biotech, not a lot of biotech, but just a representation of the global equity market.
Graduation question real quick.
Oh, and quickly, every manager in the portfolio is graduation ready. A lot of these firms have been in the portfolio for a number of years. They are mature firms, especially when you look down at some of the names like Brown Capital, who's kind of stretched above that $10 billion mark as a firm. One of the firms, Redwood, was recently Fred Alger took an ownership stake into that firm. And so some of these firms are going beyond the emerging definition. And that's one of the things that we want to talk with Fernando and Virgil and the investment team, James, about how do we refresh the portfolio and stay true to the nature and what you all want to do with emerging managers. So I'll keep those comments short, but we're happy to share our ideas for the portfolio. We always have a number of ideas for this portfolio.
Excellent. Thank you so much. We have gone over, but I think it was worth every minute that we did go over. Thank you so much for sharing with us. And I know I kind of, when you mentioned affordable housing, I kind of threw a little curve in. And we really want to hear about that. And as a board, so thank you. Thank you for accommodating us. And this has been a wonderful presentation.
Thank you. And thank you for hiring addicts 20 years ago.
Yes.
You can see that we turned that $100 million investment into a $4.2 billion firm that's still around after
Yes,
20
indeed.
years.
100
So thank you
million.
very much.
2004. And what I really have to say is that paying it forward, everybody's getting a business, everybody. You have just really lifted a lot of people up, and that is totally commendable.
We love our job.
Yeah.
Well, can you all just catch the roses?
All right. Thank you.
Okay,
You have a
thanks.
great afternoon.
Thank you.
Mhm. I don't want to be seen. Wait.
Oh, is that what? Thank you.
You know what? I gotta do. You wanted to say thank you. Because when I used to start
You know,
housing, we were so jumping in. So thank you for letting us go. I know what this board wants to make sure. And that's what we need to do. So thank you. I mean, you're our chair, you could stop. So thank you for tolerating. Yeah, no.
Oh, you're welcome.
Oh, yeah, I knew why you were asking that. I knew why you were asking that. Okay. Do I have a minute to give me some coffee? Okay. Don't give me. I don't know. No, you're right. This is Chicago Day.
Fernando, just a brief pause. We'll get the board back in just a minute.
Got it. Will do. Okay.
You know, that might be a good idea to add 5 minutes between. Huh? Right. Well, you know what? Everything's full and I don't want to miss another meeting. You remember I was waiting at the last
I think she's,
and they just went over there with me.
right. I know, I figured it out after
And
the.
it was my chair. That was not right. They could have said, wait a few minutes, let's go to the next. Because they know it's only 2 back there. And there's so many of us.
Fernando?
Okay. Okay, so our next presenters are members from JLC Infrastructure. It's an entity that's owned in combination by Loop Capital and the Magic Johnson Enterprises. CTPF is invested in their maiden fund, JLC Fund 1, and JLC is actively fundraising for Fund 2. And so we've asked them to come in and provide an update of Fund 1 and discuss plans for Fund 2 as well. So James, please invite our guest in from JLC.
Thank you, Fernando. Good morning and welcome to Chicago Teachers First Friday. With us today from left to right, we have Trustee Barajas, Trustee Vincent, Trustee Nelson, Trustee Washington, Executive Director Lenore, Trustee Blackwell, Trustee Price Ward, and Trustee Ochoa, our Chief Investment Officer, Fernando Vincents, our consultants from Callan, Van Weymouth, and Bernie Bazil, along with investment staff. You'll have 25 minutes to present, followed by 5 minutes for questions, and you may begin your presentation now.
Good morning.
Good morning.
I'll start with a brief introduction. My name is Tasha Henderson. I'm the Chief Financial Officer and Chief Operating Officer at JLC.
Okay.
Rob Keogh, Managing Director and Head of Infrastructure at JLC.
And good morning, Marlon Smith, Managing Director with JLC.
So I'll start us off with just a brief, quick overview of JLC and how we got here, and very briefly of where we are today. I'm sorry, you can go to page 3 of the presentation, please. So as stated earlier, JLC is a joint venture between Loop Capital and Magic Johnson Enterprises that started in 2015. Hopefully most of you are aware, but Loop Capital is a global financial services firm based here in Chicago that provides investment banking, brokerage, and advisory services. Magic Johnson Enterprises also does a lot of work in more socially impact. The venture came together because Loop Capital did a lot of work in the early stages of infrastructure development and saw that doing some interest as an advisor and an underwriter, that this would be a natural extension to their services. Magic Johnson Enterprises, interestingly enough, is a friend of the firm. They also saw an opportunity in infrastructure. So in 2015, the joint venture was born and JLC was created. During that time, I was the Chief Financial Officer at Loop Capital Markets, and so I had a dual role as CFO of Loop, CFO of JLC as it was getting started, and played an integral role in that process. Today, JLC has 2 offices in Chicago and in New York. We have raised a little over $1.5 billion in assets under management across 18 limited partners. 2 of them are Illinois State Pension Plan based, and 1 is Chicago Teachers. We have deployed over $1.3 billion in assets in support of over $15 billion in projects across the US. I'll throw it to Marlon.
Sure. Skip to maybe you can see page 4, where we highlight 3 of the founders, Jim Reynolds, Irvin Johnson, Eric Holloman, and some of their backgrounds and their roles, with JLC. But importantly, I want to get into page 5, which we can talk a bit about, our approach to investments, and then Rob will talk a little bit about our results, which, as an investor in Fund 1, I'm sure you have seen and are keen to see how they're looking today. So our approach, as Tasha mentioned, we focus on the infrastructure sector. We work in public infrastructure, which includes different types of public facilities, transportation, which includes airports, roads, energy, which spans some traditional energy, but more importantly, energy transition, in particular around solar and other renewable assets, and then lastly, communications. We got 3 things that have made us, different as we've executed on the investment strategy over the last, 7 years or so. One is our sourcing advantage. We find ourselves in some of the most attractive infrastructure investment opportunities because we are the partner of choice. And why are we the partner of choice? As you see on our founders page, they've worked over decades to build relationships with state and local governments who are responsible for making decisions around infrastructure, who want us, as their partner, and with corporate leaders, many of which are industrials that we partner with in the execution of infrastructure projects. They want us on their team. The second reason is because over the last 7 years, we've made some investments in some of the most significant and notable infrastructure projects in the country. When you think about LaGuardia Airport and what it took to get that from a shovel in the ground to what it is today, which is one of the top ranked airports in the country, if not the world now. When you look at what we're doing at JFK and New Terminal 1, which is about a year and a half into construction, we've just been involved in assets that many others want to get involved in. And so when they look to partners that have experience that can help them succeed, they want to work with us. And because of all of that, again, we believe excellent deal flow, which results in us having a choice in which investments we want to pursue for our investment vehicles, such as the Fund 1, which you were in, and obviously Fund 2, which we're currently raising. A second element of our approach is we're very thoughtful around execution and structuring of deals. Again, we're an equity investment focused firm. We do seek control positions in our investments, or if we're not a control investor, we're a very active minority investor. But in all cases, we develop governance frameworks and incentives to align interests with either our investment partners as well as our management teams who are critical to the execution of the investments. And then the last piece, and this is paramount to infrastructure, we certainly like good returns, and that's what we underwrite, but we are just as focused on downside protection. So we structure all of our assets with a very intense focus on ensuring that downside is protected. Again, these are infrastructure assets. They should have long-term, stable returns, and they should be counter cyclical, if you will. And we employ prudent leverage strategies. Most of our assets, if we do employ leverage, we'll typically have an investment grade rating on any debt that's affiliated with the asset, which again gets to what we believe is a prudent approach to leverage on our investments. The third piece, alongside the other two, is our value add approach through active asset management. And we have a senior team, that each boasts an average over 25 years of experience. And we believe that provides us with a very good vantage point to identify and manage infrastructure risks. This includes construction risk. We've seen construction projects go right. We've seen challenges arise, and then we understand how to deal with those challenges. And then when we think about our partners and the ability to drive operational improvements, in the assets, leveraging the experience relationships of Magic Johnson Enterprise and Loop Capital, we believe we have a unique approach to maximize value creation of the assets. We have a strong investment team, including 11 investment professionals, that work across all these sectors. And this team has been together in large part for the last 5+ years. So we've developed a rhythm and cadence of working together. And then the second piece is strong support from our founders. They are deeply involved in the execution of the strategy and leveraging relationships and the resources of their organizations. So what does all that mean? And I'll let Rob tell you kind of what that is translated into in terms of our track record.
Thanks, Rollins. Rob Keogh, we'll go to page 6 and quickly hit on performance of Fund 1, which you're in. Currently, we're at roughly 23 to 24% gross return for the firm and 12 to 13% net return for the firm. That's as of year end. Actually, Tasha, our CFO, was getting out our financials just before this meeting. So very timely information. As you can see on page 6, we do have 10 investments in the firm. We've got 7 of those in Fund 1, which you're in, and we have 3 in Fund 2, which we're raising. We'll talk about how the investment performance is doing and getting into some of the details in a minute. Flipping to page 7, this is just a picture of the team. You have 3 of the senior members here in front of you. The rest of the team has been very stable. As part of Fund 2, we did add 3 new members, about 2/3 of the way down the page, Dan, Lisa, and Radish. But everybody else has basically been together, as Marlon indicated, from 2018 forward, and there's really been no attrition. So a very cohesive team that has built this track record together. Flipping to page 8. I'm not going to spend a lot of time on this page. Page 8 shows a graphic of our universe that we play in. So again, infrastructure is focused on hard assets. It's a unique asset class at this point. There are a number of larger global players in the space. You see those names on the outside of the page. We're on the middle market end of the platform, and so we're much smaller. We actually don't bump up against some of these larger names. We operate in the US. That's where Irvin and Jim have their relationships. That's where we do our best work, and so we really don't deviate from our sweet spot. But this page helps as we talk to audiences such as this. This helps orient ourselves versus kind of the broader infrastructure market. Some of the things on the right, Marlon's already hit on. We are a P3 leader. You'll see that in the deals. We have a very localized presence. Again, Loop Capital is based here in Chicago. Irvin is based in LA, but they have offices all over the US and touch points. And maybe we'll flip to the next page just to translate what that means. Page 9, please. What that means in terms of deal flow. These pie charts represent the activity level we have, and I think on the screen you don't have any numbers around them, but they give you a sense of the type of deals we're seeing. So green is obviously the biggest piece, and green represents sustainable energy. So we have in our platform a solar business. We have an energy efficiency business. So actually we've sold that. We look at a lot of clean energy. That's the green, and you see what that translates in Fund 1. There's a big piece of green. That's the solar platform. We don't have any of that in Fund 2 yet. The other pieces I highlight are the transportation. So that'd be things like LaGuardia Airport, LAX Airport for Fund 2, JFK for Fund 1. That's a big focus. And then it's labeled conventional energy. I think the more topical term for this is energy transition. We would never, we don't do coal. We don't do anything of that ilk, but we do some things around natural gas, which is a transition fuel. As we see, it's a transition fuel to the full clean energy we'll see in the next 15 to 20 years. This is really a transition energy play. And you see some of that coming into Fund 1 that you're in, and we'll talk about what that means. I'll quickly go to, I'm going to skip page 16 in the interest in time and go to page 17. Which is actually labeled page 11. I'm not sure why it's labeled page 11. Let's see. Go. Yeah, it's page 11. Oh, it is page 11. Sorry, my page numbering is off in my deck. Apologies. Page 11. If we could go to that. Let's see. Page 11. Just looking at the screen. Is yours 17 also? Yeah, so it's kind of, okay, yeah. So page 11 in our decks, there we go, that's it. Good, thank you. We're just gonna spend a minute on this, just to give you some specific examples of what we've done with assets in Fund 1, how that translates into Fund 2, because our thesis and our approach to market really doesn't change. I'll start, and then I'll ask Marlon to jump in as well. And so we'll really start, and there's kind of 3 levels here that we think about value creation. One level is growth platforms, where we're essentially buying businesses, and through our relationships, through our partners, able to grow them faster than our competitors. Second bucket is P3, public-private partnership, management, delivery, and achievement of goals. And we'll talk about what we do well there and how that translates into investor success. And then the last one is really taking an existing asset and understanding how to optimize and bring value to maybe an existing asset that's already operating, or building an asset that is going to be operating. We'll talk just through how value is created in that channel. So just at the top, I mentioned in Fund 1, you see Green Skies referenced here. That's our solar platform. And this solar platform actually does what's called commercial industrial scale solar. So it's not rooftop residential solar, but it's also not the big utility scale solar where your customer is ComEd or somebody like that. This would really be selling to school districts. So a school district might say, I'd like to actually be clean. We go in and put panels on their roof or next door, and we'll actually make them a clean energy school district. It could be other public sector buildings, and it could be private corporates. And so we do a lot of work with Home Depot, Lowe's, Best Buy, where we'll go in, put solar on their roofs, and they'll become totally green. So the Best Buy store that you're in would actually be a green store. They wouldn't actually be burning any carbon-based fuel. So that's the platform. We've been able to buy this platform. We own it. We've been able to expand it through the network of Loop relationships. As Tasha mentioned at the beginning, we are an affiliate of Loop Capital. They routinely call on the very same customers that Green Skies call on. So, the schools that are raising debt that Loop advises on, we ultimately call on the same school to go install panels. That overlap allows us to actually incubate business development a lot faster than our peers and capitalize on that. And so we identified that advantage early on. We've gone into Green Skies. We've invested over $100 million ourselves. We've brought in Allstate as a co-investor, and now we've brought in Hull Street Energy as another co-investor, and that platform continues to grow. Eventually, what you'll see in this platform is a very large number of operating solar assets that we will sell on to the next buyer in 3 or 4 years. So that's what we did in Fund 1. That actually translates into Fund 2, Marlon, if you want to talk about GeoLinks.
So GeoLinks is a fixed wireless internet service provider. So think of something that looks like a satellite dish on someone's home, but instead of broadcasting television, it's broadcasting high-speed internet. And it's relevant in places where you don't have fiber because fiber is too expensive to build. And so GeoLinks, the company, is about 11 years old. We made an investment June of last year in the company to really help it achieve its growth objectives. 3 things that were interesting about the company. One is it had secured $180 million of grants from the Federal Communications Commission to build wireless networks in parts of California, Nevada, and Arizona, and we're helping with the build out of that. And secondly, it owns spectrum that covers those areas, and the spectrum is, obviously what allows the wireless communications to take place. And most fixed wireless companies operate on public spectrum, which some of you may be familiar with because a lot of it's related to public use, such as schools. But they acquire proprietary spectrum, which allows you to deliver a higher quality of service relative to either competitors who are on public spectrum where you might have more interference. And then the third piece is leveraging our relationships with a lot of the larger communications carriers who might need wholesale relationships. So this is a company that we see as one, critical to delivering service in underserved markets, which is a core part of our thesis. And then 2, again, leveraging our relationships in some of the other areas to allow the company to achieve more growth than it otherwise would have without us. So we're excited about that one. The next 2, which I'll talk about, are in the area of public infrastructure delivery and risk management. One point I'd highlight is JLC. If you think about you're probably familiar with what's going on at O'Hare Airport in particular. With airports are looking to renew themselves, right? We hadn't had airports built in this country, up until LaGuardia, which I think is the first airport in 20 some odd years. JLC is probably one of the few firms that have been involved in all major airport redevelopments over the last 10 years where there's been private capital. So we're an investor in Denver Airport. We're an investor in LaGuardia Airport Terminal B, which we talked about. And the next 2, we'll talk about JFK New Terminal 1, and then what we're doing out at LAX. On the left side, JFK New Terminal 1, this is a brand new, roughly 3 million square foot new terminal at JFK Airport that started construction last year. JLC is one of the lead investors. We own a 30% interest in the project and helped lead the development of the project until we broke ground in 2022, which again, about 18 months ago. And looking to open the first set of gates in 2026. It's going to be, some of the tenets around it were world-class airport, building capacity to allow JFK as an entire airport to deal with the capacity that it expects in the coming years. A critical element of this project has been our partnership with the community, right? Intense focused on workforce development. We're looking at 15,000 plus jobs created out of this airport, and making sure that those go to minorities and women. When you think about minority-owned businesses, we have a 30% goal, which translates to well over $1 billion of spend with minority and women-owned firms and local. And again, 18 months in, I think we're ahead of that relative to the things that have been procured and awarded. And we do that in a way, what makes us different is pushing our teams to think differently about how you deliver those. It's not easy, to have a small company take on $100 million project without putting themselves at risk. So how do you break packages down? And really pushing our management teams to think creatively about that. And that's something we're pretty proud of helping lead. But the project itself is, again, underway on time, on budget, and again, 18 months from now, hopefully we'll be opening, the first set of gates. How does that translate into what we're doing in Fund 2? We like to wash, rinse, repeat in a sense. So Los Angeles World Airports, which manages LAX, had a problem, right? Similar to JFK having a capacity problem and needing new capacity. Well, they had a problem on the cargo side. If you can imagine, LAX is a key gateway for cargo on the West Coast. And currently, most of it is dealt with in over 2 million square foot across, 20, 30 buildings, right? So you think a lot of congestion traffic. So they challenged our team to come up with a solution to, one, increase capacity, and two, increase operational efficiency. So our plan is to consolidate much of that, those buildings down into a smaller footprint. In particular, the hallmark of it is a 2-story cargo facility, first in the country, where you're going to clear up a lot of truck traffic and improve operational efficiencies and create increased capacity. Our team executed pre-development agreement with LAWA, again, Los Angeles World Airports, last year, and are currently in the process of preparing documents for the FAA so we can achieve environmental approval and ultimately build a project with the goal to have the project completed before the Olympics in 2028, which obviously been held in LA. So that's just, again, 2 examples of, how we, like to wash, rinse, repeat, based on what we've been able to achieve in Fund 1 and how we think we'll do it in Fund 2. And then, Rob, I don't know if you want to talk about NEC and how that translates.
I'll go quick on those 2. NEC is in your Fund 1 portfolio. NEC is a LNG facility. You might have heard of liquefied natural gas facilities being built down on the Gulf Coast. Those are for export of U.S. gas. This is not that. What this is a small scale LNG facility actually built in New England. New England has a shortage of natural gas in the wintertime, particularly when it's the really cold days. What happens is everybody turns on their heat and there isn't enough gas available. And so to address the issue, what happens is utilities keep extra gas in the form of liquid on site in New England. The problem is there isn't an easy way or an efficient, cheap way to get that LNG into New England. The only way is actually through a port in Boston Harbor until we built this facility. This facility sits actually on the main gas line that brings gas into New England. So in the summer days where people aren't actually heating their homes, there's excess gas available. We actually take the gas off the main line, we liquefy it on behalf of the utilities, then we sell it to the utilities under a long-term contract. This allows the utilities then to store that gas in the summer. They sit on it, and then in January, when it's really cold, they actually turn the liquid into a gas and they send it off to their customers to heat their houses. This is a project we came into relatively late stage in the permitting process. We financed the late stage development. We oversaw the construction. We financed the project with debt and our equity. It just became operational this spring. And so now we're actually delivering gas to the utilities, and they're actually storing our product. This is really, if you live in New England and follow the energy news, our project is a bit of a godsend for what they're trying to achieve. It prevents the need to add new pipes. It prevents the need to do a lot of things that would actually have otherwise negative consequences, both environmentally as well as just a public policy way. So that is Fund 1. We've continued that in Fund 2. Conceptually, we are an investor in Hudson Yards, which is the big New York City development. We acquired the cogen plant, which provides all the hot water, the cold water, and the electricity to the Hudson Yards development. This type of energy is actually much, much more efficient than if they bought off the grid. So when you think about cleaning the environment and reducing carbon emissions, doing it through a cogeneration plant on site that does it all in one is about 30 to 40% better than what you would do if you were buying off the grid. So this is a way to, number one, help from an environmental standpoint. Number two, provides reliability as a standalone, essentially an energy island for this particular area of New York City because they're separate and apart from the broader grid. So that's in Fund 2. So I think, we're kind of coming up on time, and we're happy to answer any questions. Page 13 does have the full list of assets in Fund 1. We've covered most of these. LaGuardia, we're actually selling our stake in the process of exiting that to our partners. So that will be our next exit. That should be imminent. And then AOC Connect is a fiber business, telecom, that's actually based out of the Washington, D.C. area, that provides high security, high clearance, fiber access to really the most restricted government buildings in DC. It was a business started by ex-military that have high security clearances, and now we own that business. So I'll pause, and I think the three of us are able to answer any questions that really anybody would have.
I have one question. I'm really intrigued with this liquid gas. And since the New England states were the first states colonized, why don't they have gas?
Yeah, it's a great question. So, not to bore the audience, but so a lot of the New England homes were traditionally heated by oil, and so when you thought about like the older homes, they were oil heated. And so what happened in New England over the last 30 years, people wanted to get cleaner. Oil heat is extremely dirty. And so they converted their homes from oil to gas. At the same time, you had an introduction of more industry in New England, a lot of which relied on gas to fire their processes. Whatever they were doing, they needed gas. New England also is a not in my backyard type place. And so the logical thing would be to build a pipe from the Marcellus Shale, which is in Pennsylvania, not too far away, just build a new pipe and bring more gas into New England. That'd be the easy way to do it. But New England definitely did not want that or allow that. And so what happened was with all this new demand, they just had a shortfall of gas. And so to deal with it, rather than building new pipe, if you can plan ahead and say, look, really, I'm only short 7, 8, 9 days where it's really, really cold and everybody's turning up their thermostats, then I can address the problem without having to create all this new pipe or figuring out another way to get gas into New England. And so that's what our plant really does. It takes the excess gas in the summer and allows these utilities to store it for the winter, and it addresses that demand problem. So it's kind of been an issue that's been building over time, but it's really an interesting story, and I could actually talk about it for a while and really bore everybody, but good question.
Thank you. That adds to my Revolutionary War unit that I'm working on with my students. So I can tell my students, hey, I got some new information today. All right, any questions? Trustee, okay, yes, I'm sorry, Trustee Nelson.
Thank you. I'm gonna put it on right now.
Wait a minute, what's that?
We agree to a 9 o'clock. I like it. Good.
Trustee Woods, you're unmuted.
Okay, sounds good.
She can't hear you.
The new hire situation is going well. The consultant, thank you for hearing me and
We're hearing from the Board of
halfway.
Education.
I will tell you.
Okay, she figured it out. We'll get ready to text her. Mhm.
Okay. So should I go on?
Yes, please go
Trustee
ahead.
Nelson, I'm
Trustee
sorry.
Nelson.
At any rate, I was noticing on page 11 that you've been doing ESG for quite a while. And
Yes.
that with the solars and the geo links with the wireless. So at any rate, a lot of folk don't really talk about those positives in the ESG field. And I'm just surprised because I'm assuming that you're doing that in a lot of different places.
Yeah.
It's a great point. And actually, page 15 of our deck has some ESG slides. We didn't get because of the time, but we track ESG very closely. And I think there's two areas we're particularly good at. And I think actually the S in ESG we excel. And I'd compare us to anybody in the investment world in terms of job creation for local communities. And Marlon talked a little bit about that at JFK. But if you ever are in New York and you want to take a tour and you want to see a project and you want to see how the community is involved in the project and the benefits the community gets from jobs being created there, I think we are an exemplar for that. And that's something that really starts at the top. So that starts with Irvin Johnson and Jim Reynolds, because that's kind of how they've always run their businesses. And it comes through us. And so I think the S part of the ESG, we are exceptional on. The E part, we track very closely as well, the environmental piece. And as you said, we have a solar platform in the fund you invest in, which is purely focused on the conversion over. We also did have an energy efficiency business, what actually worked with the East Aurora schools just west of here to go in and retrofit those schools with energy efficient boilers, HVAC units, windows, insulation, roofing. And we actually financed all that. And that greatly improved their carbon footprint because they basically had been operating with equipment that had been there since the 50s. So thank you for bringing it out.
And actually, we might be in New York the end of next month. So what do you suggest that well, I'm just saying my family, anyway, suggest as to what you were saying. When in New York, where do you go?
Yeah, so actually, the Chicago teachers can reach out to any of us and we can facilitate if you're interested in kind of taking a tour or having somebody just show you what's going on and kind of say, look, this is how it's happening. This is the involvement. Just let us know ahead of time. I think they have our contact and we're happy to facilitate that. Absolutely.
Thank you. I appreciate that.
Yeah.
John. Okay, and after John, Trustee Rod. You.
Great. Thank you. Great presentation, great update. I'm just curious, entirely different interest rate environment from Fund 1 to Fund 2. So first part, does it change the underwriting in general and in terms of targets and the gearing? I know you guys, that's not a huge part of your strategy, but does it change the underwriting for that when you look at what you did at Fund 1 versus Fund 2, even, talking about JFK versus LAX, does it change the targets? And then 2, does it present a hurdle for future deal flow?
Yeah, that's a great question. So on Fund 1, the fund that you're in, we are not financial magicians. We're not ex-Wall Street bankers. And so we take a very conservative approach to financing. And so if you look at our assets that you're in, they are all backed by long-term debt, or in the case of JFK, we've actually hedged the interest rate risk. So we're not really taking interest rate risk. And so from what do we have in the ground now, you're not going to see things come up in the portfolio you're invested in that we say, oops, that was brought on by interest rate. We don't have refinancing issues. There's none of that in our portfolio that you're invested in. So don't worry about that. On Fund 2, you make a great point. What kind of environment, what sort of pricing environment are you in? The good news is that the way we look at assets, and the assets, frankly, we're attracted to, there's levers to drive value. And so we've never been, frankly, about financing advantage. There are funds out there that, do take advantage and understand that, frankly, maybe better than we do. And they kind of play around with the financing structures. We actually, if you look at, LAX, the value drivers there, even pre-interest rates going up, never came back to, the financing structure. That was not part of it. So I don't think, at least in the types of assets we're focused on and the types of assets we're able to deliver value on, they're not as exposed to interest rate risk as maybe some operating assets. So where do you see pressure? If you're buying an operating business that's very stable and throwing off cash flow, the price you're going to get if you're selling that and the price you're paying for that asset, you would actually be paying less and the seller would be getting less because of where rates are. We don't really buy those type of operating assets, so you're not going to see that dynamic in our portfolio. So I think we're actually, from a fund perspective, we're in a very good position, regardless of kind of where rates go, because that's not a big driver of either new transaction activity or what we already have on the books. Hopefully that answered.
Yes. Trustee Riley? Trustee Riley?
Yeah, I hit mute. One question is, where is your local office now? The address?
425 South Financial,
That's what I thought. You're in the same building with us.
27th floor.
Right. What floor are we on? 14 and 15?
Yes.
Yeah, I know it took you a while. It took a while to get there, but I knew you were moving there. So, and I was thinking you're talking about doing things to the schools in Aurora. Can you imagine trying to do something with the schools that were built in 1925 in Chicago? Just a kind of a rhetorical question.
Yeah. Well, I was gonna say, interestingly, there have been, and again, we can get into a whole, political discussion around it, but if you think about Prince George's County, Maryland, they've done 2 rounds of schools under the public-private partnership model. Should Chicago think about it? I mean, obviously, it's up to the board and, the city to figure out, but we do think there's some interest across the country in how private sector can help renew the school facilities and do so in a way that reduces risk to the school boards and other agencies and reduce costs, right? But obviously it's not that form, but we think it's something we'd be keenly interested in. Yeah.
That was
The last
my
building
question.
I taught in was 1925.
We have
I mean, it was a
summer.
fortress, but it wasn't really built for heating.
No, I was gonna say, I thought the Biden administration has a green school initiative, and I think we're doing something in Chicago as well. So you guys are in contact with folks to get that done?
Right, but we have buildings of all ages.
Yeah, we're not in particular in Chicago, but but we'll be open if it came up as a procurement. Yes. Mhm.
Yes, I have some. You had your hand up?
Okay, thank you. So my question is that since infrastructure as a type of asset class and you invest in the middle market, so the ticket size, how do you separate like infrastructure to private equity or private credit type of players? And also as an inflation protected asset class, do you have certain ways that you underwrite in your portfolio to get that type of benefit?
Yeah, good question. So let's, if I break that apart, when you think about infrastructure generally, I think about it as cash flow protection. And what that means is you'll typically have a monopoly position. So for instance, if you own LaGuardia Airport or JFK Airport, there aren't any other airports in there. So you have a monopoly position. If there's air traffic, you're going to be able to capture that from a revenue profile. Otherwise, if we were owning, let's use our LNG facility as an example, that operates under a long-term contract with a utility. So they just pay us for a service effectively. And we have great visibility. It's a take or pay. So whether they take a little bit or a lot bit, they're going to give us a check. And so we have very good visibility on the cash flow. And there are no competitors. And so when you think about infrastructure, first part of your question, infrastructure versus private equity versus debt, Certainly, we're not debt because we're very we're an owner. We're taking owner's risk, we're taking owner's upside. But we're not private equity because ultimately it comes down to visibility of cash flow. Every asset you see in our portfolio will have an underpinning of some nature, whether it's a monopoly position or whether it's a contract, where you have great visibility of cash flow. And that's very different than private equity. Private equity will buy a business, they'll try to make the business better. Hopefully they fix the business or make it better, more efficient, and then they'll sell it to somebody as a better, more profitable business. That's not really us. So that's kind of how infrastructure fits versus those others. In terms of inflation protection, we typically have pass-through ability on inflation to our customers. And so, for instance, at LaGuardia Airport, the price of beer that we're selling there will certainly at least go up with inflation. And so you can pass through the pricing ultimately to the customer. So that when you say inflation protection, that's really what you're talking about, pricing power. Same thing under the contracts. Typically, the contracts are priced at a base rate, and they usually have a CPI or inflation linkage going forward. So every year they will effectively track inflation. So as you see a high inflationary environment, you're 100% right. Infrastructure tends to follow along and be protected and be much more resilient than other asset classes, simply because we have much cleaner pass-through structures, whether contractual or whether through monopolies. So I think that addresses the inflation linkage. I think those were the two. Did I miss anything? Okay, thank you.
Paula, Trustee Barajas. You go ahead.
So I guess these are yes, no questions. For Fund 2, have you presented to CalPERS or CalSTRS since you're working at LAX and that is in their state? Or for Fund 2, have you presented to the New York Teachers Retirement System since Huston Yard is in their state?
So first question, we do talk to both CalSTRS and CalPERS a lot. CalSTRS actually invested through a separate account alongside us in JFK Airport. And so we certainly are actively in discussions with both those entities, not just about LAX, but just broadly. But certainly LAX is in their backyard and they know it. And so that's something I follow closely. New York State, we certainly talked to New York State Common and New York City pensions, and are very active in obviously New York City, and continue to keep them updated. I don't know if there's anything Marlon or Tasha you'd add.
No, because we're running out of time, and it was about where Magic Johnson Institute in terms of private investing in schools, but we don't have time, and I will ask.
Well, I have a question pre-COVID. You were here last, and I specifically asked about Chicago Public Schools and if we could kind of drive in that direction. There's a lot of infrastructure work and a lot of capital development going on right now, total overhauls with schools. And it would be nice if it could go solar, something, to that effect. So I'm gonna ask one more time. Can you all please, if that's within your plan, but it would be really nice if you could just take a peek, see what's available. Okay, thank you.
Thank you.
Thank you for coming. We have really enjoyed this presentation.
Thank you very much.
Yes.
I appreciate it. Thanks everyone for the time.
Yes. 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 It is time for dismissal. Please line up and get your coats out the locker.
Okay, so the next group presenting is Muller and Monroe. And so it's a name that some of the trustees are familiar with because we've invested with them in the past, but we're not currently invested in. And, but they're currently in the market for their latest commingled fund offering. So we've asked them to come in also, so we can get familiar with them again. And as a fund of fund manager, Muller and Monroe doesn't invest directly in the underlying companies, but instead invests in the private equity firms who do invest on behalf of institutional investors like us. So James, please introduce the representatives from Muller and Monroe if they're in the room.
Thank you, Fernando. Hello and welcome.
Good morning and welcome to Chicago Teachers First Friday. With us today from left to right, we have Trustee Barajas, Trustee Vincent, Trustee Nelson, Trustee Washington, Executive Director Lenore, Trustee Blackwell, Trustee Price Ward, and Trustee Ochoa. Our Chief Investment Officer, Fernando Vincents, our consultants from Callan, Brianne Weymouth, and Bernie Bazil, along with investment staff. You'll have 25 minutes to present, followed by 5 minutes for questions, and you may begin your presentation now.
Excellent. It's a pleasure to be here. My name is Erwin Loud. I'm the Chief Investment Officer of Muller & Monroe, also known as M Squared. And joining me is Marsha Markowitz, who's the Managing Director and is part of the investment team that invests in new deals. I will follow the presentation that we provided to you and flip. So if we could turn to slide number 2, that is the contact information that you requested. And then on slide number 3, the elevator pitch, the overview. M Squared is a Chicago-based minority-owned private equity fund of funds focused on managers that invest in the lower middle market. We invest in buyouts, growth equity, and special situations. We are focused on high performance, but we also provide diversity. The firm is diverse, and many of our mandates for large public pension funds are diverse, and we have separate accounts and commingled funds. On slide number 4, many organizations describe their business in terms of sports or war, and the head of the firm, Andre Rice, likes to say that a better metaphor for business is music. Music is about creating something of lasting value and of collaboration. So we have branded ourselves the M Square Band, and you will see throughout the presentation references to band. So don't let that throw you. But we think that the collaborative nature of what we do, particularly in the lower middle market, focused on smaller, newer managers, makes it critically important that we have unique backgrounds and experiences that enhances our risk management. On slide 5, it is indeed a pleasure to be here partnering with you. If you're not aware, you were part of our founding LP base. Chicago Teachers, IMRF, and SERS put us in business in 2004, and we are eternally grateful. We have gone on since that time to grow substantially. I think at the time we had only a handful of employees, and you were our first commitment. But we have continued the tradition of focusing on high performance and also providing diversity in the investment portfolios. I see a number of familiar faces in the room, and it's a pleasure to be back before you again. Not present today is Mary Riley, who I think was on the board. Oh,
she's on the call.
Oh, I'm sorry. Okay. Well, it's good to know she's in the room, and pleased to reconnect with Fernando Vincents, who was a client of ours with Cook County, and Cook County continues to be a client of ours, and others in the room who had worked with us in the past. So we feel like we are among family, and it's a pleasure to be presenting to you again. On slide number 6, if you ask our clients what they would say about us now, I think they would say we're honest, hardworking, we're good at what we do. Our motto is do what you say you will do, that we provide great client service, and that we're good partners.
Our clients are California State Teachers, which has invested with us 3 times. New York Common, which has invested with us 3 times. State University's Retirement System of Illinois, which has invested with us 3 times. The state of Connecticut, which has invested with us 3 times. And so it was a little bumpy when we got started. You were a founding LP. Our first portfolio, ILPEF, Illinois Private Equity Fund of Funds, was our character builder. It underperformed. There were lessons learned. The strategy was very broad, and we have fine-tuned. And what you see today is M squared 2.0. And when I talk about our performance, you're going to see tremendous improvement. Our second fund with you was MPEF, M Square Private Equity Fund of Funds. It was an okay performer, but there were still a lot of lessons learned that have enabled us to fine tune. And Marcia's going to talk a bit more about our strategy and how we refined. But if you'll turn to slide 7, I want to put our performance in a bucket. We presently manage 11 active pools of capital as of 9/30. And there is I apologize, there's a typo on the slide. It should be 8 of 11, and 1 is too early to evaluate. 8 of 11 pools of capital are outperforming our benchmark. For a benchmark, we use the Russell 3000 using a public market equivalent. It's using the methodology of assuming all of the cash flows are invested in from our portfolio are invested in that index. So you can see whether you're outperforming or underperforming that public market. And so 8 of the 11 are outperforming a benchmark. 7 are outperforming the benchmark by over 650 basis points. And 3 of the managers are outperforming the benchmark by over 1,000 basis points. You heard that correctly, over 10% over the benchmark. And what you're going to hear is a description of an investment strategy that really captures an inefficient part of the private equity market, which we have captured. And with refinements that we have implemented, we have gotten much better, and we have developed consistency. What are the changes that we've made? Well, we no longer do early stage venture. We no longer do mezzanine. We no longer do SBICs. And we've drilled in on what we do really well, which is buyouts, growth equity, and later stage strategies like special situations. We have refined our due diligence process by taking the key elements of success in an emerging manager and put that into a scorecard, so we have a quantitative method of evaluating qualitative factors. We have a tool that we use to do portfolio construction to pit the managers against each other to figure out which deals are the right fit in the portfolio. We use an industrial psychologist to vet management teams so that we understand the team dynamics and can manage those risks. And a whole host of things inside of a very disciplined investment process have made us able to create consistent performance that has enabled those clients that I mentioned to come back to us again and again. And so let's go to slide number 8. How should you look at us? PSEA is the framework that we use when we evaluate managers. It's the framework you should use when you evaluate us. PSEA represents the key success factors in an asset manager. In an asset manager, your assets walk in and out of the door every day, so people are the most important piece of it. And so if you look at us, it's the right team, the right set of experiences, complementary experiences, the right culture, the right set of ethics. Strategy, it should be unique, differentiated, and repeatable and scalable. And that is certainly where we have found ourselves. Execution, perhaps most important. Execution embodies track record, disciplined investment process, differentiated sourcing, and most important, compliance and reporting. And then finally, alignment of interests. That's skin in the game. That's having a legal structure in which your interests as clients are are put in front of the manager's interests, and that the structure enables us to all be rowing in the same direction. And so if you come on site and read our investment memos and talk to the junior investment team, everyone's using the PSEA framework to disaggregate, to peel the layers of the onion of risk assessment as we look at managers. And so the PSEA enables us to consistently evaluate risk using a common language. On slide 9, you'll see the members of the senior band, as we call them, Andre Rice, who founded the firm. We started the firm in 1999, and the senior leadership has not changed significantly since then. We've had very little turnover. As you can see, just by looking at the pictures, that the M Square is diverse by design. Everyone on the team has institutional experience, and the 200 years of experience resident on the team reflect both institutional portfolio experience, both me, I built a private equity program at the Florida Pension Fund. There's investment banking experience, principal investment experience, entrepreneurial management experience, and fund administration experience. And so while we are a boutique, we are focused on client service. And so it doesn't need to be big in order to give you institutional quality execution. On slide 10, what is our competitive advantage? There are other fund of funds in the market that invest in emerging and diverse managers, but what we give you now is consistent outperformance and an intense knowledge of the space. And we think that sector expertise, focusing on what you do well, is critically important in asset management. We have been focused on emerging and diverse managers since we started the firm in 1999 and have just gotten better and better. The organization has been stable. The organization is diverse, and we focus on diversity in our investment portfolios when that is part of the client mandate. We have differentiated, customized due diligence because we're investing in new groups that may be spinning out of larger organizations. We understand what it takes to vet a manager that is good at investing but has not run a firm before. And so we know how to assess and manage the risk of new organizations, but not new investors. We would not invest with a new investor, but we will invest with a team in a new organization. Mm-hmm. And we are ultra client service oriented. And I think if you talk to any of our clients, you'll see it's not just what we have in the partnership agreement. It's what, when they pick up the phone and they need to get a real answer offline, you know, we understand what it means to be a good client to a large public fund. So at this point, I'd like to transition to Marsha Markowitz to talk about our investment process and portfolio construction.
Thanks, Erwin. Good morning.
Good morning.
Good morning. We like to say that our tagline of our investment strategy is small funds, big opportunities. And we've consistently seen that throughout our 20 plus years of investing in this space.
Excuse me 1 second. We're on slide 11. Mm-hmm.
We're focused on the lower middle market, and I'll get into a little bit later why we like this space in private equity so much. But just to define it a little bit, we're focusing on managers who invest in companies that typically have enterprise values of 25 to 250 million. So these are smaller companies. They're way out of the target of brand name funds. These are really smaller managers who are investing in kind of the small cap, if you will, space of private equity. As Erwin mentioned, these are seasoned investors. We like to again say new platforms, old investors in terms of their experience, their ability to have, their networks in the space, their ability to access deals. So these are truly seasoned investors with track records. Some examples are spin-outs from larger firms, teams that have lifted out. They might be teams that come together from multiple firms but have worked together before. Spin-outs from larger, from family offices, and also serial deal investors, groups of people who are investing on a deal-by-deal basis and have decided to form a fund. We'll invest in first-time funds, Fund 1 through 3, and we'll follow managers if they're performing, as long as they are executing and staying in the same strategy. We won't follow a manager if they're moving up market or if their fund size gets typically above $1 billion. The fund sizes that we target are between 200 and 500 million. We'll invest in smaller size funds, but only if we're confident that they can sustain financially the firm, and it's not a small endeavor financially to run a private equity firm. So we have to be sure that they're stable financially. And again, we'll invest in larger size funds as long as they're staying in the same strategy. Our focus is primarily in later stage strategies, so growth equity and buyouts. As Erwin mentioned, we do not invest in venture any longer. And we do have a smaller allocation to special situations funds as well. Why do we like this space? Again, as Erwin mentioned, this is a much less efficient part of the private equity market. While it's not always the case that deals are truly proprietary, these are not investments that are trading in large auctions. There's typically a handful at most of bidders for these companies. And oftentimes we see our managers cultivating relationships with sellers so that by the time these companies go into process, there's already a relationship established. And often the deciding factor is not just price. It's definitely partly price, but it's not just price, it's also relationships. So it's truly a less efficient market. The multiples are lower than with brand name funds. And there's greater opportunity to add value with these companies. They're smaller companies, they're less professional. They really need the help of a seasoned operating executive or seasoned investors to take them to the next level. And that's what our managers do. They work very closely with management teams to take the company to the next level, and then are able to sell them into that brand name market or closer to that brand name market where they can get a nice multiple and have a multiple arbitrage. So it truly is a good part of the market if you understand how to assess these types of managers, because they're smaller, they're newer, and there's risks that you don't see with brand name funds. So that's the area we have expertise in. We also like the fact that we're investing with the people who are actually doing the investments, who are actually working with the management teams. They don't send junior people with a lack of experience to work with these management teams. They named partners whose track record we're relying on are the ones that are working with management teams that are helping them get to the next level. And lastly, we like that the financial interests are well aligned. These managers often haven't built personal wealth, so they're still working really hard to do that. And we can often get terms that are more LP friendly than an LP would get in the brand name market, because they're newer managers and they understand that there's a higher risk associated with it. So we often get, and we spend a lot of time securing good terms on these investments. If we go to the next slide, page 12, I'll briefly cover our portfolio construction. We manage both separate accounts and commingled funds, but across any portfolio, we look at several features. Diversification has to be diversified by industry, region, stage, vintage year. Again, we're focused on later stage strategies. We're typically looking at 10 to 12 underlying funds in each portfolio. So we limit the exposure to any given fund to 10%. And we're looking to do 3 to 4 deals per year within a 3-year commitment period. We are usually allocating within 2 years, but we have that 3-year period. And again, we're customizing every portfolio, every separate account to clients' needs. And Erwin mentioned earlier, our diversity.
Slide 13.
Yeah, thanks. If you look at our portfolio, you'll see the natural reflection of the MWBE significance in the lower middle market. Over 74% of our capital has been invested with MWBE managers, and that's compared to the industry average in this space of 8.5%. So we're really pleased with the level of diversity that we've built in our portfolios. And
Slide 14.
14. Thanks. We're really pleased to share that we have recently launched our co-investment platform. Greg Walker joined 2 years ago with really impressive M&A experience from Viacom, Sony, Goldman Sachs, and has helped us build this platform. We're now able to allocate up to 20% of recent commitments to co-investments, and we've executed on 2 deals to date with a really strong pipeline sourced from both our GPs and other GPs, and primarily our GPs. And we've seen for years a really strong pipeline of co-investment opportunities. So we're really excited to be able to begin investing. We're following the same diversification parameters with our co-investment platform. We're diversifying by sector, case sizing, and all the other diversification features that we're looking at with our funds. And we're looking to do 2 to 4 deals per year and 8 to 10 deals total for the portfolio. And I will turn it back to Erwin, who will talk about our recent launch.
Okay. Excellent. Thank you, Martha. If you could, 2 slides. We're one behind. I want to be on slide 15 that says Libertas. Yeah. Excellent. Yeah. So we are before you today asking you to kindly consider our latest commingled fund. It is an opportunity for investors to invest in our core strategy. This is a commingled fund, which means a number of limited partners can invest in this platform with us, so you don't have to negotiate a separate account. We have $300 million on the cover. It will continue to invest in lower middle market managers, buyouts, growth equity, and later stage strategies. This platform will have co-investments. So 80% will be invested in primary funds, 20% will be taking pieces of deals, and that's going to dramatically boost the return of this platform. So we're excited to be adding co-investments. U.S. diversified, broadly geographic diversified by industry, region, stage, and vintage year, same as the past. This is a minority-focused fund, so all of the managers will be minority or women managers. And that is by design, because we've had a number of client inquiries to have a platform that really embraces ESG and DE&I. It's something we do naturally anyway, but this particular platform is designed for investors who want minority and women managers. Other than that, the term structure is essentially the same, and it's competitive, competitively priced and structured. The City of Boston, through NEPC, New England Pension Consultants, has committed $15 million to this fund, and we are actively looking for other LPs. There is a data room open with the legal documents, and we would love to have you consider being an anchor investor in this fund. We would also be happy to talk with you about reestablishing the relationship in a commingled fund. It's indeed a pleasure to be back in front of CTPF again, and we were disappointed that we weren't able to get you to invest alongside CSRS, which has one of the highest performing portfolios that came behind you, but there's a chance for you to catch up. So we'd like to extend the relationship. And I guess the final slide, why should you partner with us? Demonstrated success, stable organization, exclusive focus on emerging managers, tremendous client service, and we're a diverse firm based here in Chicago. And then finally on 17, DWY SYWD. If you walk into our office, you'll see letters on the wall. This is our motto. This is how we want the junior people to hold us accountable. We expect you to hold us accountable. So with that, thank you so much for the audience, and we're happy to take your questions.
I have a question. Can I borrow that for my classroom wall? Will you approve?
Yes, absolutely. We'll come and install it for you.
Thank you. I was gonna put it up and let them figure it out and then let them know this is what we're about.
That's funny. It's funny that you mentioned that, because that's what we have in the office is we just have the letters up, and we say that that's a test that managers have to pass. If they can figure it
like
out,
it.
then they move to the next level of due diligence.
I like that. That's exactly what I had in mind. Okay, great minds. Any questions? Yes, trustee Barajas.
Hi, so you do fund to fund, and I noticed that you're in the private equity sector. I guess what's your rubric or philosophy, or how do you look at private equity in terms of not just DEI, but also in terms of labor rights, right? For their portfolio companies, right? So how do you, I didn't see that here, so I'm curious about how do you do that?
It's not a specific part of our screening, but I can tell you that so much of what we do is focused on alignment of interest. And we think value creation comes from alignment structures so that interests are aligned from our clients to us, to the underlying managers, to the portfolio companies, to the people who make it happen, both their customers and the management teams. And so we don't have labor or employment mandates, but our due diligence is extremely intensive. And a big part of what we're doing is to invest with managers who treat their people right and who understand the alignment of interests at a portfolio company. For our CalSTRS relationship, we have to do explicit ESG screening for 25 different factors. We are signatories of the UN Principles of Responsible Investment, and we are adding incremental steps of ESG to our investment process, so enhancing the screen that you go through when you first get in our shop to when we write our investment memos to how we evaluate the managers. We have an annual review with each one of the managers. We want to get updates. Am I answering your question?
Sort of. I'm just, if it's not part of your screenings, how are you making sure that those managers and their portfolio companies are respecting workers' rights?
Mm-hmm. I understand. Our due diligence process in looking at the deals that they have done in the past and the legal platforms that they have used involves looking at problems that they have encountered. So we will look to see whether they've ever been sued, whether they're outstanding litigation, what is their position in the marketplace. And we look at the internal policies and procedures that embodies the culture of the firm. And so every firm that we've invested with has sort of an operating manual that would have human rights policies, their own ESG policies, their employee rights and disaster preparedness, the operating framework that you would expect to see in an institutional firm. And if we don't see what we're looking for, then we're going to ask about it. Our operational due diligence digs in on specifically things like that. And our back office team goes on site and evaluates financial controls, redundancy, IT, and their operating policies.
Yeah, I mean, just to put a little finer point on it, we are looking at every investment, we are looking at the ESG programs of the underlying managers. So we're not validating at each underlying company level, but we are looking at how the manager approaches ESG And that does, that does address some of the concerns you're mentioning. But we don't go on site to each portfolio company and validate it, but we do spend time with the managers, making sure that they've addressed ESG.
Understand that you don't have time to go to every portfolio company. If the managers themselves have a screening process for their portfolio companies, that's an easier way for them to tell you, we're respecting workers' rights. If the managers don't, then that's problematic.
Right, and many do. I can't say with assurance each of them have specifically addressed that, but many do and many track it.
So I see broadly it has industry, but what are your investments, I guess, by industry? Where are you, mostly invested in, and I guess highest and the lowest, I guess?
Sure. Right now, the highest exposure is going to be technology, and I'm going to speak a minute about that. We build the portfolios that are diversified by industry, by region, by stage, and by vintage years. And yet we are not giving you a passive portfolio so that you got too many relationships. In industries, we want sectors that are recession resistant in manager strategies that enable us to performance across cycles. Technology has become the largest because technology is pervasive in America. So even if you're looking at healthcare or you're looking at software, software would be technology. If you're looking at financial services, for example, much of that business is technology as well as the financial services. And so we are in the process of disaggregating pure technology versus the technology that you would see in an insurance business or a healthcare reimbursement. We will not invest in heavy consumer brick and mortar. And we were thankfully well insulated during COVID. We were not in any hospitality, very little hospitality, and very little brick and mortar consumer. And we won't invest in things that have heavy commodity pricing risk, nothing fad related. We want solid companies that are growing, that need managers to take them to the next level, that are going to survive economic cycles. Did that answer your question? Yes.
Thank you. Let's see, any other questions? Any other questions? Summer?
Hello, Summer.
Sorry. My question is, so since you have a very long track record and also experience in the emerging manager program, and also you're underwriting most of the managers in the NWDBE status. And how have you seen this area change from the past 10, 20 years ago compared to now? And what kind of problems they are solving? And what do you think is mature enough for this space? It's just a very broad question, sorry.
I understand. Thank you for the question. There's good news and bad news. The bad news is that less than 2% of the institutional pension market is managed by minorities and women. That was the case when we got started, and that's the case now. And despite major efforts to improve that, it still has not moved the needle, and that's what's discouraging. What's very promising, to your question, is that we've seen more and more emerging manager programs created, largely driven by the large public pension funds that have put people like us in business to create platforms to invest across the board. By having those emerging manager programs in place, it entices someone inside of a big shop to leave and hang a shingle knowing that they can get funded. And so we've seen the universe of managers increase, the support for them increase, trade associations related to those in businesses increase, organizations like NAIC and NASP and AAIM and Women in Private Equity. Those trade associations help people find the relationships. And so it's gratifying to see other people investing in the space, because we're not doing a deal by ourselves. Other people need to invest in the deal. So it's nice to see that ecosystem expanding. We have a long way to go.
Are there any more questions? Are there any more questions? Seeing none, thank you so much.
And
for
thank you so
presenting
much
today.
for the audience.
This has been very informative for us, at this presentation.
Excellent. Thank you. Enjoy your afternoon.
All right, you as well.
You too.
Right.
Okay, so our last presenter, we've invited Newport Capital to come in and present today also. Newport Capital invests in real estate, primarily in neighborhood retail centers within densely populated markets. Newport is in the market with their fourth fund. And so we would like to hear an update on how the other three funds that we're invested in have performed and what they have in mind for Fund 4.
Okay, good afternoon and welcome to Chicago Teachers First Friday. With us today from left to right, we have Trustee Barajas, Trustee Vinson, Trustee Nelson, Trustee Washington, Executive Director Lenore, Trustee Blackwell, Trustee Price Ward, and Trustee Ochoa, our Chief Investment Officer, Fernando Vincents, our consultants from Callan, Brianne Weymouth, and Bernie Bazil, along with investment staff. You'll have 25 minutes to present, followed by 5 minutes for questions, and you may begin your presentation now.
Thank you. Good afternoon. My name is Derek McGavick. I'm representing Newport Capital Partners, and I'll turn it to my colleague to also introduce himself.
Well, my name is Alex Smith. I've been with Newport Capital Partners for 5 years, and I'm currently a managing director and head of asset management for the firm.
And we'd like to make this as interactive as you all are interested in, but we'll just kind of skim through. If you wouldn't mind looking at page 3 of the deck. So Newport is we're a small manager. We'll get into our history a little bit, but we are focused on neighborhood community retail centers. We're a very sector focused manager, and we're very, very focused on certain aspects of that sector. The other thing I'd like to point out is you'll hear a lot about us talk a lot about population density relative to its importance in our property niche. We are less concerned with household income, but we are very focused on population density. And then the other thing I'd like to point out from page 3 is that we are a middle market investor, meaning in the real estate space, we're looking to acquire assets with 5 to a maximum of $20 million equity per investment. We think that's an inefficient portion of the market that delivers relatively higher returns for comparable risk. If you wouldn't mind going to page 4, I'll give a very brief overview of our organization. We've curated this organization over the course of the last 12, 14 years. We have had a couple changes, I think, since the last time we presented to the board. One, we have our former head of asset management left to go join another firm, more of a private equity type organization than a private equity real estate firm. But I'm very pleased that given how we built the organization over the last, again, 15 plus years, we were able to promote Alex into that role without missing a beat. Alex is now the head of our asset management group and effectively portfolio manager for Newport Fund 2 and co-portfolio manager for Newport Fund 3. And then just to get a little bit ahead of ourselves, although it's not official, I guess this makes it official. Roseanne Moore, our CFO, she's been our CFO for about 10 years. Roseanne is now a mother of 4 under the age of 8. And let's just say between being a CFO and a mom with 4 under the age of 8, something had to give. So Roseanne, and I give her so much credit for doing this because she's been a great partner for the last 10 years. She's going to become a full-time mom. Again, given the nature of our firm, we're really happy that Margaret Borgia is stepping up and accepting more responsibility and accountability and is going to be running our accounting functions. So I just want to give the board a context of changes of the organization over the last really 6 months or so. Page 5 is a brief summation of the history of Newport with CTPF. We can honestly say that CTPF helped put us in business through Newport Fund 1 and your participation in the Emerging Manager Fund of Funds vehicle. Not to mention, we were asked in significant part by CTPF to be the new GP for the DV Urban portfolio, and we took that over. And I don't know what was a happier day, taking it over or selling the last asset. Probably selling the last asset. Truth be known on that. CTPF was our lead investor in Newport Fund 2, key investor in Newport Fund 3, and we'll talk about it very briefly at the end. We're going to be launching Newport Fund 4 in the last part of this year, and we're hoping again that CTPF will continue its investment in our closed-end fund series. With that, I'll turn it over to Alex to talk about our investment vehicle performance with CTPF on page 9 or page 6. Sorry.
Thank you, Derek. This is a snapshot of portfolio returns in the vehicles that CTPF has invested in. And overall, despite having to deal with the COVID-19 pandemic and last year of rising interest rates, we are happy with the returns generated. In Fund 1, we just this last week have sold the last remaining asset, which was located in the Lincoln Park neighborhood here in Chicago. And as a result, here shortly, we'll have a distribution from Fund 1. In Fund 2, again, having to deal with the COVID-19 pandemic and last year of rising interest rates, that's delayed us about a year or two from selling out of properties out of Fund 2, and that's created a drag on the IRR. However, with that being said, we are happy with the equity multiple we're projecting to be able to achieve for the fund. Looking ahead for Fund 2, over the next year or two, we'll be liquidating the remaining assets. Turn to page 7. To echo Derek's earlier comments, we have really a very focused investment strategy of acquiring neighborhood and community retail centers. As Derek mentioned, we emphasize population density as well as vehicular traffic patterns and counts as opposed to income levels. And we seek a tenant mix that really serves the daily needs of the neighborhood. At the moment, we've got 6 assets within Fund 2 and 3 that reside in the Chicagoland area. 3 of those are within low to moderate income neighborhoods. And we're actually about a month away from closing on our 7th Chicagoland asset, which is located at the intersection of Ashland and Roosevelt, bordering the Rush Medical District to the south. And that will be our 4th investment in a low to moderate income area. Turning to page 8, this slide is just a representation of the merchant mix and diversification we strive for within our properties. If you look at the representative tenants with Jewel-Osco, Kroger, Athletico, Dollar Tree, you can likely visualize the type of properties that we seek to acquire. And the last thing I'd like to point out here is that 60% of the total revenue throughout the portfolio is driven by the grocery, personal service, healthcare, and off-price merchant mix. So with that, I'll turn it back. Oh, actually, excuse me. I'd like to flip to page 10 and just touch on a few key statistics within the portfolio. Looking at the top left corner, this is a snapshot of Fund 2 only. And since the COVID-19 pandemic, since 2021, we've seen robust leasing activity throughout the portfolio. We've been able to grow occupancy by almost 6%. currently with a portfolio average at 93%. And we've been successful in renewing or reletting space for 96% of expiring leases and have been able to push rents almost 5% in that process. As a result of those efforts, we are projecting net operating income for 2024 to grow by 13% over 2023. And looking down at Fund 3, a very similar story to tell here with robust leasing activity. Since inception of the fund, we have grown occupancy by almost 5% throughout the portfolio, currently at an average of 94%. We've retained or relet 99% of expiring leases and have grown rents by almost 7% in that process. As a result of all of that effort, for 2024, we're projecting net operating income to grow by 15% over the prior year.
Kind of going back a page to page 9, the combination of the robust leasing activity that Alex mentioned, coupled with in our sector, there's extraordinarily little new new supply. There's a lot of demand by tenants, but there's very, very little supply. According to Green Street, it's basically, 0.2% of supply growing. That's nationally. I would argue in the markets and submarkets that we invest in, if anything, new supply is frankly, or total supply is shrinking. So that puts us from a property level of a supply-demand imbalance to the good way. We've got way more tenants interested in our spaces than we actually have space. So it's a very positive trend. And that's kind of is a segue to page 11, where we're 3/4 of the way through our investing in Newport Fund 3. Once we close on Ashland and Roosevelt, we'll probably finish our investing in Fund 3 during this calendar year. And our goal is to commence raising Newport Fund 4, which will be exactly the same investment strategy as Fund 1, Fund 2, Fund 3. And we're looking to kick that off towards the end of the year. We managed to do that inside of almost 15 minutes. Any questions we can address for the board?
Yes, Trustee Walsh.
So, hello. So this Fund 4, where's this located?
Which one?
The Fund 4, this I'm looking at.
So Fund 4, we invest in 16 markets across the U.S. We specifically stay away from what I would call tertiary markets, because during an economic downturn, if you have to exit, it's difficult to exit a tertiary market when there's an economic downturn. On the other hand, we also stay away from the gateway markets, Los Angeles, San Francisco, Southern Florida, New York. And we do that because, frankly, there's such a supply of capital chasing a finite number of investment opportunities in those markets. We believe it drives down returns, and our money can never be green enough. Your money can never be green enough to really make a decent return on its investment in those markets. So we're going to be investing in Chicago, Minneapolis, St. Louis, Cincinnati, Austin, Houston, Dallas, Atlanta, Raleigh, Tampa, Orlando, and Charlotte. Those are our primary markets that we're investing in.
Can I ask another question?
Yes, you may.
So, okay, so for example, the investment at Ashland and Roosevelt.
Yes.
What is that, Whole Foods or something?
It's actually a Jewel.
Jewel, you did say that. Okay. And so when you're investing in Chicago, for example, so Ashland and Roosevelt, that's up the street from where that Costco is.
Mm-hmm. Yes.
Kind of a West Loop kind of space. So what type of investments are you all doing in that retail space south of, because what I find is everybody goes into the West Loop or they go into like Fulton Market area and stuff, but people aren't coming south. You know, where so then you have like these food deserts in places like, there's a Jewel near me. I live in West Pullman. I don't know if you're familiar with Chicago. Well, you are.
Well, yeah, we're Chicago.
Right, you're, duh. So, so
and I have to confess, I have the worst imagination on earth. Newport is based on Newport Street in Wrigleyville. So it was a toss-up between Newport Capitol or Southport Capitol.
Got you. So I am in West Pullman. I live about maybe 5 to 7 minutes away from the Pullman National Museum at 111th and Cottage Grove. I'm just south and just west of there. But where I am, the closest grocery store would be the Jewel, for example. That's on 119th and Marshfield. I'm on 121st Street. Or I have to go to the Walmart on 111th and Doty Road off of 94. In my car, that's not a big deal because it's about a 6 to 7 minute drive to the Jewel, or maybe a 7 to 10 minute drive to the Walmart. On foot, you know, that's just not gonna happen.
Right.
You know, so for my neighbors that that are not mobile, it's dry around there, you know? So when I think about retail investment, inner city, and I get it's all about spacing and all that stuff too. You know, what, as you all are investing in places like, and I'm using Chicago as an example because I live here, but even in St. Louis or in Atlanta, are you looking at markets where the investments are already kind of limited to expand that space, to expand the quality of life for residents within those specific areas? For example, and I don't know if, you know, just off the top of my head, maybe this is some type of a vision where if you all are investing in retail, where retail is combining with an affordable housing strategy, where you all are working together to really build a market or build, you know, accommodations so that people can have affordable housing and the necessities that they need around that affordable housing. Because affordable housing is only as affordable as the amenities that it allows you to have.
Right. I'll try to answer that in two ways.
Okay.
So I'll use the St. Louis example.
Okay.
Because we have in Fund 1 and in Fund 2, we have several investments in low to moderate income neighborhoods. Now, one of the key things about Newport that we're highly sensitive is how much risk are we taking in return? And one of the challenges in today's world, and frankly, it's been a challenge for well over a decade, is taking development risk that's a lot of risk. But I want to put an asterisk on that for a second. So for example, in St. Louis, we were under contract to buy a center, and I'm sitting at home watching CNN with my wife. That happened to be when Michael Brown was shot, and the cameras are spanning the commentator said, "Let me show you the center where we're at." He's spanning the center, and I looked at my wife and I said, "I need to go to St. Louis tomorrow because we're buying that center." So we do buy in low to moderate income neighborhoods, which actually Ashland and Roosevelt fit in. We're not developers. Developers is a skill set in and of itself. What I will tell you is, in addition to Newport Fund 4, as we're looking for future development, because we look at our retail as really workforce retail. It's not Main Street. Even though we've got the photo of Whole Foods on here, we actually redeveloped that center, brought Whole Foods in. We didn't buy a Whole Foods center, and we're probably never going to buy a Whole Foods center. But when we do want to eventually launch a workforce retail vehicle that frankly partners with somebody who's on the workforce housing side. And that's the one area I can say that I think we would actually develop product. Does that help answer your question?
And I guess that's kind of my point. Like, you know, when we're putting our money, we are all teachers.
Right.
That are required to live in Chicago. So when I think about and I'm a veteran teacher, I've been at this 22, 23 years now. So, but when I think about the new teacher that's fresh out of college, that's required to live in Chicago and is paying rent or staying at home because they cannot afford to pay rent, you know, I'm thinking about those individuals. I'm thinking about PSRPs, personnel, support personnel within school buildings and within the district whose salaries may not be the same, but they're required to live in the city as well. So yes, that answers my question. And I'm hopeful that as you all are making these allocations and things, and I don't know if it becomes a municipality, it's some type of a joint venture between, like you say, the powers that be. I can't call it what you call it.
Really, it's two different expertise, sets of expertise. People who do workforce housing, generally speaking, the ones who do it well, that's all they do. Just like in our niche, we are one of the very, very few neighborhood-only retail center investors. And I think we're probably the only that has as a specific goal, Fund 2, for example, over 50% of our investments had to be in low to moderate income neighborhoods. In Fund 3, we actually set up a sidecar vehicle, which we'll probably do again in Fund 4, of a low to moderate income, literally side by side vehicle. The development expertise is one that we just really don't have. And you need that developer expertise to do it right. Otherwise, we'd be putting CTPF money at risk. And that's the conundrum. We don't want to ever be in a position where we get out over our skis and put your money at risk as a result of that.
Thank you.
Trustee Price, we have Trustee Barajas, Nelson, and Riley. Trustee Barajas.
So you say that supply is low, demand is high, right?
Yes.
And you just indicated that you're not the experts in development. So, you know, Addix was here. Addix was here. They were the first presenters. They are talking about, you know, workforce development and housing.
Right.
You're talking about, you know, high demand, low supply. If you could do that south of Roosevelt, both of you together, that would be great. Just think about it.
Well, we've been spending a lot of time thinking about it, not just for a Chicago-centric vehicle, but for example, in Fund 3, our first investment was in Austin, and it's actually in a low to moderate income, primarily Hispanic neighborhood. So our goal as we continue to grow the organization, build out our organizational strengths, we want to get into some of those skills. One, because there's a need.
You don't need to get in some of those skills, right? You don't need to get in some of those skills because you have other managers that have that skill set that you could.
Right.
That's right.
It is absolutely a goal of our organization.
And I kind of think that was the point I was getting at.
I just wanted to nail it for you.
Thank you.
Trustee Rice, we're here to
Yes,
Trustee
next.
Nelson and Trustee
Trustee
Rice.
Rice.
Oh,
Trustee
okay,
Nelson.
thank you. I want to go back to what you said about DV Urban taking it over at that time. That was your first connection with the pension funds, is that correct?
So it was a weird series of events. When we first started the company, we were one of the bidders on taking over DV Urban. And appropriately, I believe it was Chicago Police said, wait a minute, these guys are a little too small to take it over.
Uh-huh.
And in fairness, that was probably an accurate statement. At the same time, we raised Newport Fund One, and literally the week we were closing on Newport Fund One, your former consultant called us and said, "We need your help. Would you take over
Right.
DV Urban?" And we said, as long as our LPs are comfortable, we'd be happy to do it.
Okay, but now later you said, or today, that, was it that you were saying you may not have done it at the time?
No, we definitely would have done it at the time.
Okay.
It turned out to be a much more challenging assignment
Uh-huh.
than we remotely thought when we got into it.
Okay, because I was, looking back on that page 6 and it was, kind of questionable, and I just wonder, how you felt about it at this point, because that's been a lot of years.
It was a while ago. It was a lot of effort, and frankly, we'll be eternally grateful to CTPF for giving us the opportunity.
Thank you for answering it.
Trustee Riley?
Thank you. Are you out of Eden's Plaza now?
We are out of Eden's Plaza. So Eden's, we've sold 3 properties in Fund 2. Eden's Plaza, which I think was a great buy and a great sell, but the people going actually to the development concept, if anybody has seen Eden's Plaza recently, it is it's going through a huge redevelopment.
It's taken forever, and it's Wayfair's going in there.
It's taken forever. It's Wayfair that's going in there. And it was, the more we dug into how complex that investment was, the more we realized this is exceeding the skill set of our organization. And that's when we jumped on the opportunity to sell.
Yeah, I mean, it was the old Carsons.
Right. We actually bought the entire center except for the Carsons. And then we bought the Carsons out of the Carsons bankruptcy. And we tried to put a Target in there. We tried to put an IKEA in there. We tried 3 or 4 things. And it just was getting more and more complicated. And I'll be honest, I've never been happier selling an asset. And it ended up doing very well for the fund.
Yeah, I mean, you just watch it. My brother lives in Wilmette, and it's like, is it ever going to open?
Okay.
Sometime.
All right.
Yeah.
John?
Thank you for that great presentation. I can remember when, the new 4-letter word was office, but pre-pandemic it was retail. Nobody wanted to be in it. There were, oversupply and all these issues. But there was always a thought that, grocery anchored, necessity-based retail would hold up better in a downturn. And not to discount the misery that the world went through from 2020 to 2022, but it provided an opportunity to see if that thesis was true. I was wondering if you could just talk about when, being on the front lines, doing, very niche strategy, very local strategy, very focused. How did rents hold up? How did tenants hold up? I know we were on the phone with you talking about, what were the leases, and never had a sense of discomfort, like everything was in line, even in the most difficult times. But how did you guys experience it through, that 2-year period?
So during that 2-year period, the one thing that we were very pleased about, and Alex chime in, I don't mean to monopolize the conversation, but the group of tenants who were the best and easiest to work with were exactly who we thought they would be, and that was mom and pop organizations. Because these were tenants, for example, we had a POB, Plaza on the Boulevard in Jennings, Missouri, Southtown, across the board. The non-national tenants, this is their livelihood. This is how they're keeping a roof over their head, feeding their family. They did everything they could to pay. So what we did at the very start, we did two things. One, for the tenants, we went through literally every tenant and every non-national tenant, I should say. And we gave 3 months of free rent to get some breathing space. We didn't give it away. We asked that they pay it back to us over time. But we basically did that for all of our small shop tenants. For our national tenants, there was no such thing as a free lunch. So no, they didn't get, Starbucks, for example, didn't get any rent breaks. Having said that, the tenants that were frankly the most challenging to deal with were larger tenants like Ross. TJ Maxx was wonderful to deal with. They're same literally industry segment and two very diverse perspectives on how to work with landlords that were so in the weeds, John, as a investor, operator, manager. I think that gave us a leg up in actually working with every single tenant and doing it on a personal basis with our asset management team. And at the end of the day, we collected from, I think we only had 2 tenants that went bankrupt during COVID. And we ended up collecting 99% of all the rents during that COVID window. That was probably too long an answer to your question.
I remember that period vividly. We were having daily conversations with these tenants and elected to be more of a partner with them. And as Derek alluded to, entered to these deferred rent agreements. But in addition to that, we helped them get signed on for PPP loans. And again, just try to be a good partner of theirs. And as a result, we had very strong rent collections through that challenging time, have maintained strong occupancy levels. And coming out of that period, as we touched on some of the key metrics we've seen since coming out of the COVID-19 pandemic, our properties are better off for it.
So understand, like thinking about the property on Ashland and Roosevelt, understanding you're not developers, but are you like renovators? Because it's been there for a long time. It's probably in need of some structural infrastructure. Stuff. So
we do as part of our value add strategy, some redevelopment, sometimes minor, sometimes major. The Whole Foods picture you see on the screen, that was a major redevelopment. That was a Jewel. Jewel went dark. And I'm sorry, it was a Dominick's, and the Dominick's went dark. Yeah. And we were able to get control of the space and bring Whole Foods in. At Ashland and Roosevelt, one of the things that to me is fascinating about that property is, as you noted, it's only a block away from a Costco. Yet, at the risk of getting too micro, one of the most important issues for a grocer is what's called their health ratio. It's their sales. It's actually their total rent divided by their total sales. The smaller the number, the better. Jewel has a very, very low health ratio. So where we see the real value in that center is one, Jewel's going to put in $2 million of their own dollars to refurbish their store. We're going to try to work with them to see if we can help them on the exterior and perhaps get a longer lease term. And then the other thing, there's a couple tenants whose merchant mix doesn't really quite fit the neighborhood. So what we're going to do is, one in particular, replace it with, knock on wood, a medical use, because we found medical tenants very, very sticky in the long term, and they bring a lot to the neighborhood. Excuse me.
Are there any other questions? Okay, go ahead.
I'm sorry, I couldn't hear you.
I think Alex might be watching some basketball tonight. Absolutely, yes. Go Hawks, go Caitlin Clark. Yep. Dan Gable's getting pushed off to the side for attention, and now it's Caitlin's town. Yeah, I'm from Iowa. If if you didn't gather that. And we don't have these types of moments often. We don't have any professional sports. So we're very, very excited and happy for Caleb.
Do I hear any other questions? Any other? Okay, seeing none. Thank you so much for coming, Newport. We really enjoyed your presentation. And thank you for being here.
Thank you very much. I hope everyone has a great weekend.
You as well.
Thank you.
Is that meeting one? Is it up to CTPF? All right. Fernando, thank you.
Yep, sure. So again, to recap today's session and identify next steps. So as you can see, CTPF has great familiarity with all four of these firms, and it may have been a while since we've received updates from them directly. So this was, I think, good timing. But it's also timely because they have funds in the market or are working on initiatives that could provide an opportunity for us in the future. So let me go one by one. Addicts, we're not really seeing anything immediate that we need to do with addicts in terms of, given that they're on watch, but because we do have monthly and quarterly updates with what staff does with addicts. And I think we've got a really good working relationship with them. We like them. We continue to work with them to identify ways to improve the portfolio. But this, I think, affordable housing initiative is new, and so we'll try to stay updated on that and bring that back to you with any significant updates. JLC, we are currently conducting due diligence on Fund 2, and we will be bringing this to the board in an upcoming meeting, perhaps as soon as the June board meeting. And Muller and Monroe, again, while we're not currently invested with Muller and Monroe, our current pacing study that you approved at last month's board meeting, we've penciled in an MWBE private equity search. So perhaps they can respond to that search, assuming they meet the parameters. And then lastly, Newport, as they mentioned, they'll be launching Newport Fund 4 later this year. And so I think we have this targeted for in-depth due diligence once the data room comes out and they've got more information for us. So that wraps it up for me.
All right. Thank you so much.
You're most welcome.
Yes.
I have a question and actually, it's not a question.
It's a statement, right?
It is. So I do think, thank you. This was very informative today, and I like what I've heard. And I think that CTPF being the standard setters that we have been and standard bearer, I think that I would like to see us really be intentional about the way that we are blazing a trail through what affordable housing should look like. I think that we need to be demonstrating to other municipalities what that looks like, even if that means that we need to figure out how to partner, and I use that word very loosely, but how do we navigate bringing these entities together from the municipality to, where it comes to workforce, retail? How do we build communities within this city that, and not just within specific areas? Because when I see development around the city, I see it in specific areas, and nothing, I won't say nothing, and I won't say limited investment happens south. Limited investment happens west, and it's changing. But when we think about where a lot of our students in the school district are and in those communities, to the point that the last people just made about the way that they invested in where low and moderate communities, one of the reasons that these communities are low is because disinvestment has happened
Right.
for decades, and it has depreciated these communities. So with our public dollars, for our members that are public employees, I would like us to stabilize the communities that we are all living in by way of our investments that are still profitable and being done in a responsible manner. So I guess that's my challenge to Callan and to our staff.
Yes.
Figure out a way, and let me say that a little bit nicer. I think I'm hungry now. Let us work together to find a way.
That's better.
to bridge that so that we can, even if it means if we have to be innovative and create some type of a something that bridges that or brings all those parties together and pilot it somewhere to show, hey, this is how this can be done and this can work. Now, that was a very wide canvas, and this kind of goes above my expertise level to a certain extent, but I do know what this real estate market looks like in Chicago, especially on the South Side. I'm a South Sider, and I'm a realtor that works the South Side. And we need more investments in the retail spaces that help to secure or to stabilize those communities for the people that live there and for our students.
Absolutely. I totally agree, because that's why I got so excited and we went over time with the affordable housing. I am working in a community that is very limited in retail stores, grocery stores, and some grocery stores coming and then leaving. But at our last, remember, Fernando, at our last affordable housing presentations, we had one presenter that is developing on 63rd and what is it, Cottage Grove, down from DuSable Museum. And I asked if they were going to have any plans to move further west. So there is, I see development around the hospital, University of Chicago, and other places. I'm looking at those as anchors, and maybe we could. I'm willing to. I'm looking for something new and innovative.
That part.
But the focus is affordable housing, because that is an immediate need right now. Right now, I am so happy, and even though I'm mad at my alderman, but we have a brand new Pete's Produce, big brand new Pete's Produce that will be opening soon. I don't have to go to 95th Street. I can go right there. I can walk there. And so this is the kind of development we want to see, because I look across 87th Street and Evergreen Park is doing all kinds of things.
Yeah.
They have restaurants, they have different stuff like that. So just to give you an idea, you want to go to a nice place, sit down and eat, and, where there's service, not just fast food. But I think that we do have to come together with these entities to build communities, because if we are not at the forefront of doing this, and people coming for investing for our money to invest, it has to be here. And that's why when Addicts was, when he mentioned the affordable housing, I specify in Chicago, and I should have said on the South Side, East and West.
Right.
East and West. So this is what I have heard from this board, that we want affordable housing and real affordable housing and community building, the end.
Can I ask, what would be, okay, so in the city, we know that CHA set on millions and millions of dollars for over 25 years, and there was no affordable housing investment. What role could the fund play? I mean, what can we do? Because we know there's money there.
Yes.
I don't know if there's any investment opportunities or in way we incentivize it, but that's absolutely something we need to look at.
Yes.
Things that need to happen though, too, that we keep hearing these, so it's subsidized, that's an important part of it, and tax increment financing should be pointed towards this and kept away from Cadillac dealerships and DePaul arenas. I mean, there's things there, but there's more pieces to it than just finding the people to do it. They need to find the environment that encourages it. So that whole ecosystem is complicated. But when those things go into place, these things will happen more readily. So it's not as important who does it, but that it happens. But that's a heavy lift. That is something that we need a lot of partnerships with to get those things done.
Yeah.
I guess the only last thing I would say is that we're meeting with as many managers as we can, and whenever we hear affordable housing initiatives, we dig a little bit deeper to see if there's anything that could, in some shape or form, we could impact so that or steer back to the discussion about Chicago, given again your sensitivity to and focus on this. So trust that we're out there, talking to managers, and as soon as we find anything that I think is worth looking at and bringing to you, we will make sure we do it.
Thank you so much for that, and thank you for the presenters you brought before us today. We have reached our adjournment, so I will entertain a motion for.
So moved.
Okay, Tammy was second. Okay, it's been properly moved in second, so all in favor, can you give me a roll call vote?
Trustee Barajas,
Yes.
trustee Blackwell,
Yes.
trustee Ochoa,
Yes.
trustee Price Ward,
Yeah, give me, go and do your four.
trustee Price Ward,
Yeah.
trustee Riley,
Yes.
trustee Vincent,
Yes.
trustee Washington,
Yes.
and trustee Woods. Oh, okay. Thank you.